Yeah, so students, just to check before I start, am I audible? Can I get some feedback?
Yes, we can hear you.
Yeah, thank you. So let us start pre-scene discussion because pre-scene is very important. As you know, this is 50% of your paper, especially during next 1 hour and little more time. I will analyze the case study from the angle where you can score up to 40 to 45%. And most of you may not know, I can't say most. Some of you may not know the value of this 40% or 45%. Why? Advanced business reporting is a challenge in paper because examiner can test various areas. It can be consolidation, the accounting standards, corporate governance, ethics, sustainability, integrated reporting. There is whole series of topics that can be tested. So usually if you look at any past papers, there is comfortably about 40% you can easily score if you are very thorough with this area. But very often what happens, some students spend a lot of time only on the financial reporting, and even that you can't just target to get 50. If you target to get 50, chances that you will get less than 50 is very high. So therefore, as experienced lecturer, I want to emphasize that if you are preparing, when you are preparing for the exam, target for 100%, right? I hope you can also see my screen, right? Can I do another test? Is the screen visible to you? Not clear. Screen is stuck. Yeah, I think there is a connectivity concern. Just hold on. Yeah, just hold on, students, for few seconds. There is a bit of a concern with the video. Hold on. Just give about 2-3 minutes. Right, apologies for the technical issue. I'm sure now you should be able to hear me, right, and see the screen? Yeah, thank you. And the screen also visible, right? All right, so let's start. So students, now, like I said, during next 1 hour plus little more, we will really deep dive into examinable topics. And if certain questions are tested, how you should prepare for the exams. And now there is a limited time for the exam. During that limited time, how to get the maximum. So pre-scene, I am sure you have read many times. So I am not here to read para by para, but to really get into details of examinable topics. How? Now, probably examiner may have set the paper or maybe set in that while the pre-scene done early. So obviously, you know, there are another 2 exams only, right? This paper and the next paper. After that, there will be a new syllabus. So therefore, in that context, there is also not a possibility that has to be the case. During exam life cycle, examiner is testing all the LOs, learning outcomes. So in the syllabus, if there are any areas which are not tested, so there is a greater possibility that some of the areas can be uh, tested, right? So now, as I do the session, please make sure you are also using the right. So now, first of all, I have captured the essence of case study information because the case study is catered to all the subjects, right? Now I have kept captured to 2 pages. In that, again, like I said, no point of reading all the case story here, which you have already done it. But out of these 2 pages, let's deep dive into the areas where this 40% of syllabus weightage, how are you going to get that, you know, maximum? So again, when I say that 40% in the pre-scene, you can't expect that entire 40 to come. But this session, I'm also covering in a manner that while I'm doing the pre-scene, that 40% revision is also given to you within a very short span of time. With my experience, I will make sure that you will really navigate certain critical examinable topics in this 40%, of which about 20 or 15 will be tested as a part of pre-scene. I mean, the question 3, the rest you will probably get another 1 question. That may include, if you look at last papers, how examiner has tested. Sometimes the examiner tests corporate governance as a separate questions. Sometimes examiner tests risk of misstatement as a separate questions, right? And then embed certain areas either from internal control or from risk of misstatement or from corporate governance to 50% question, right? So wherever it appears, there is definitely for you 40% dedicated for this area. That is where, if you are heading for the price for this paper, try to score 40 out of 40. With your consolidation and accounting standard related question, you can easily reach the price. Now don't laugh. We don't need a price. We want a simple pass. So always start saying, I'm going to get 100. If you are just selectively studying some areas to get a 50, the chances that you will not get 50 is very, very high. So therefore, now navigate the entire laws and see the best test to do prior to the exam is to read all the laws and see if this question comes, am I ready? Do that test, then that will ensure that you are ready for 100%. Right? For example, there are new set of LOs added on sustainability, IFRS S1 and S2, which is a very hot topic, and this year is the hottest year. Why? Because so top 100 company, and your company probably is top 100 in now if you benchmark with a dialogue case study, right? And then obviously dialogue has early adopted, as you know, S1 and S2, right? So then that's a hot topic. So therefore, you need to, I don't know whether this message is not coming now, right? So I'm sure now you can hear me and can see the screen. So before I actively start the next 1 hour, so are you okay with the voice and the screen? Yes? Can I get a confirmation?
We can hear, sir. We can hear.
Yeah, very good. Thank you very much. So are we ready? So, like I said, this is in 2 pages, the case study, and see what matters to us in this 40% of syllabus area, right? Now, this is very much similar to the dialogue case study, as you know, how they acquired Airtel and the recent merger with the Suntel earlier and recent merger of Airtel. So all of that very much similar. So I mean, let's spend time on areas that matter. So that timeline wise, how they have grown this STL company to different businesses given. And that's why in my cover page also, if you see here, the outstanding award, this award was actually given back in 2016 to Dr. Hans, GSM World Body picks Dialogue CEO for outstanding contribution to Asian mobile industry. This information also given in the case study somewhere, right? So now some of the things that I am capturing in this slide also, you need to be well aware how it can be converted to exam question. Now sustainability focus in page 4, right? Climate change and environmental. Now if you take their sustainability pillars, climate change and community impact, future work, sustainable value creation are the 4 key sustainable value drivers, right? So they have 4 pillars of sustainability. In that, one of the big topic for this year under mandatory standard is S2 application. And how are they going to quantify financial impact of physical and transition risk and other disclosures, like how do they disclose assets which are vulnerable for climate change? For example, you have seen in the case study, they talk about the cables under the sea, right? So now how those are going to be impacted with if there is any climate related risk. That's why I have some of the examples to share with you how you look at it. And finally, remember this is connecting to strategy. That's why this term shared value is very important, that ESG or sustainability as a strategy, how it is helping them to increase not only profit but their impact on the planet positively and the impact on people. That's triple bottom line: people, planet, and the profit. Then in the case study, you have financial indicators, financial reviews are given. Then in terms of business strategy, these 2 cases are clearly, when you, I'm sure after my session, the next session, which Dasun is going to take, he will do a lot of analysis of accounting standard and then how these possible. Now, these also past things, right? How they have acquired 90% of payphone, and then how they have also acquired Vista TV, right? Those things in the past, and these options, how are you going to account for these to acquire a well-established higher education, right? So this is a possible acquisition. And then option 2 is to launch a new private campus to offer degree in Maldives, right? So they are very clearly, so this point is very important. Please highlight. If examiner is asking you a question on ROM, risk of misstatement, I mean, they are talking a lot about currency risk because there are US dollar denominated, while the functional currency is rupee, the dollar denominated assets and liability which need to be converted. And also they talk about hedging. And if you are applying hedge accounting, the implication from risk of material misstatement perspective. So those areas also important, which I will touch in the session. Then specifically from risk management lens, and remember your syllabus 2-3 years ago, this change came to look at this paper not from audit angle. There is no audit. That is why the auditing standard was taken out from the publications, open book reading. Instead, you are given a copy of the study pack, supplement. And in those, certain chapters are recommended. The LOs have been changed to look at risk from a risk management framework. That is why you can expect an exam question about what are the business risk of this entity and how those are going to impact the financial statement and comment on it. That's a possible question. That is where in this paper, examiner, if examiner is asking, right, analyze the business risk and then derive risk of misstatement statement in terms of inherent and control risk. That answer are you able to write? So what are the few risks that you can write? How do you write it? That's a possible question, right? So that we will discuss what answers you would write. And then the risk management start from the business, not from audit angle. That is where these committees, they have two, audit and risk committee. So these companies, corporate governance practices seems to be, even if you look at the actual case study, a very good standard, right? So they have one committee looking after both audit and risk part. And if you look at the listing rule now, the listing rule specifically requires the risk part to be integrated to audit committee or to have a separate risk committee. And it is there in our corporate governance code as well. So those are important changes that you need to be aware. So this paragraph says how currently audit and risk committee work together, and then they are taking care of financial reporting, risk control, everything, and they are overseeing internal auditing. Then when it comes to finance risk management, this is where I told you again from a risk perspective, the currency risk, right? And obviously other source of risk like market liquidity and credit risk mentioned here. And hedging is a possible area. So we will talk hedge accounting specifically from a risk perspective as well in a later part of the session. Then this one you can easily relate to risk of misstatement. Why? Because this company has substantial, this word is key, substantial amount of purchase and liabilities of foreign operations which are denominated in foreign currencies. So those need to be converted, right? So then the risk of misstatement at that time, if they don't use the correct rate, right? And obviously there is a risk there. So that you can talk about it. And in addition, the other aspect is hedging. Now see, sometimes they say the hedging method depends on the market and currency. So please make a note, hedge accounting, right? So you cannot do hedge accounting because normally if there is a derivative, you need to fair value. Unless derivative is designated as a hedging instrument where then you will decide to park this in the OCI, right? So that cannot be done if you don't have a documented risk management practice where you identify the risk that you are going to hedge and then what is the instrument and then that is effective, right? And effectiveness is tested. Those are critical aspects of SLFRS 9, which is very, very important. And please make a note. And I have a slide on this and I will cover there. So hedge accounting is impacting risk of misstatement because they may follow hedge accounting without applying the requirements and they may not. Remember, risk of misstatement also connects to the disclosures, right? They may not disclose the hedge effectiveness properly, things like that. And that hedging is an important area. Then the most important paragraph for you, if you ask me a single paragraph that is of critical importance, that is paragraph 8, this paragraph, right? That is 18.1, extremely important, right? So why it is important? Because that is the biggest risk of misstatement called revenue recognition and why you should be able to write this answer. So this area I'm going to explain in more detail how you should write such an answer, right, from a risk perspective and how it could impact the financial statement both from risk perspective and internal control perspective. Like how do you apply COSO framework in this case for the revenue? Right? to ensure that the financial reporting for revenue is proper, both in terms of your 5-step process as well as internal control perspective, by knowing some of the specific accounting issue like bundling, right? When you have multiple performance obligation in telco, how you exercise judgment whether to combine those performance obligation or separate it. For example, like handsets, the routers, all what is given, and together with that, are you going to separate those components or not? So those areas also we will discuss, and I'm sure in accounting session those can be discussed in more detail. Then, then the other big risk, please make a note, Data Privacy Act in Sri Lanka, right? Because this type of a company, it really deals with lot of sensitive data. So that is, customers' name, ID, under Data Protection Act, those are personal information. And if you are not going to comply with it, there are legal repercussions. So most of the companies are now working towards complying with this act, having the contract with the customer to mention that, that we are only using the data, your name, NIC, birthday, for example, for the data processing purpose in business, not for any other purpose. So likewise, and these details are not disclosed, divulged. Those are very important. Please make a note about Data Protection Act from a corporate governance perspective, right? And then so this is very, very important. Why? Because you look at the heading here, your syllabus change in Jan 23. The curriculum was changed with these new LOs. And you need to be well aware about these three, which examiner can test in your paper for this case study. The possibility, right? Now, with this change, how you connect to this case study is what I want to discuss 5 minutes and go to the specific examples, right? Now, demonstrate the meaning and components of risk of misstatement, especially from financial reporting framework perspective using the concept of IR and CR. Now, this examiner wants to test in your case study because this is a LO for your syllabus. Demonstrate is a conceptual understanding more than application, right? Now, if you take the revenue recognition, in this case, why there is an inherent risk? Reason one, because you are processing large volume of data, which is passed through multiple information system, from switch to billing system, from billing system to accounting system, where there is inherently a possibility that the revenue leakage can happen, right? So this is what I'm talking. In telco, while you have accounting standard in one side, right? The revenue assurance, why in any telco company there is a revenue accountant. The internal control is critical. Why? There is, please make a note, there is an inherent risk of revenue leakage. Why that leakage happens? Because of inherent complexity. What is that inherent complexity? That arises from how you capture revenue minutes through the switch, right? And switch, it is recorded into caller detail records. And from where it comes to billing system, and again is complex because based on the time that you speak, based on the particular package, the relevant rate has to be applied. If that is not designed properly in the information system, there is a risk. And then there is a possibility that the information will not pass properly from each of these stages. Therefore, please remember this word. One of the key control in telco to, to deal with what risk? The name of the risk, revenue leakage, assertion point of view. Because with the syllabus change, examiner wants you to know the risk in terms of assertion. Revenue recognition, completeness, and cutoff is the biggest risk if you are writing answer in this paper. You can write revenue recognition, completeness, cutoff, and accuracy at risk. Why? Due to those reasons that I mentioned. The large volume of data which are processed through multiple components of information processing, right? And then the complexity of applying tariff. Therefore, there is a greater possibility that the revenue leakage can happen at any of these stages. Therefore, one of the key controls that need to be in place is to reconcile these and also to make sure IT, GC and IT application controls are proper, right? There is a robust ITGC control in terms of the program changes are not allowed inside the information system, the access, relevant access control restriction, and then how application control works in terms of data accuracy, right? So those are very, very important keywords that you will write in your answer. The key controls, the reconciliation, revenue reconciliation, minutes reconciliation, and as well as the assurance on the IT general controls relating to this IT infrastructure relating to your switch and other the information system. And remember, in the COSO component, information system is one component. So this information system is how information is coming to the general ledger revenue account through these processes, and that is covered in COSO framework under information system. So to summarize, risk is revenue, please write, revenue recognition, completeness assertion, cutoff assertion, accuracy, and if I go back as an examiner, if examiner is testing this LO, how do you demonstrate? You have to write your answer to say that there is an inherent risk in telco when it comes to capturing complete minutes accurately, right? Why? Because of the large volume, number one, and multiple layers through which information is passed from those sources up to the final accounting system, and application of multiple rates. In that context, you have to make sure two controls. One is that reconciliations. Second one is underlying in ITGC and IT application control. If those are not robust, your control risk also high. And finally, in the accounts, you will have risk of misstatement as high. So what I explained to you last 5 minutes is a highly examinable area. And you must know, අන්තිමට වැදගත් වෙන්නේ ඔක ලියන්න පුළුවන් වෙන්න ඕනේ. එක්සැමින ඇහුවොත් what are the, analyze or evaluate two risk of misstatement, 6 marks, 3, 9 marks. Write the answer. So one answer you will write is revenue recognition, these assertions, if this learning outcome is tested. The other one, which I just explained, is this. If examiner asks this tough one, because this is a high level LO, this is a low level LO. Make a theoretical ප්‍රශ්නයක්, make a advanced එකක්, right? Evaluate how significant business risk. Now, the business risk is the revenue leakage because you will not get money, right? If the billing is incorrect, and there will also be customer complaints. If billing overbilled, customer will be happy if you're underbilled, right? Say roam into all of that. Then how this revenue leakage can be a accounting issue, that is where you have the revenue completeness. See, assertion cap cover. So completeness, cutoff, right? Accuracy. Very, very important, right? The other thing is a fraud risk. And even in telco, you know, there is a possibility of fraud risk through those prepaid, postpaid cards, and there is a commission involved. All of those things can come. The other thing, if you look at inside the revenue recognition process, if it is a postpaid, right, at a month end, now that prepaid, let us say prepaid, so how do you look at the consumption and how do you really charge it? There's a lot of information system that is working, right? So I can confidently share those things that are really complex in telco businesses, right? So then look at here, when you prepare for this type of question, you need to understand, like I said, business risk here, revenue leakage and fraud risk, how it is impacting financial statement. Now, whether this is looked at not from auditing angle, this you are looking from a risk assessment. Now, risk assessment එක කොහෙන්ද එන්නේ එක? Again, COSO framework. Now, look at the COSO framework. COSO framework is a very hot topic. Examiner has tested not the last paper, one before, right? Apply COSO framework, 5 components, right? Now, one of the area, of course, of framework is to ensure, right, financial reporting is sound. Your revenue is okay. It begins with your corporate governance. That's your control environment, right? And then the next thing is, how do you assess the risk? That risk is the revenue leakage, right? Or a fraud risk. That is your risk assessment. And now from a internal control lens, we are also seeing that this can affect risk of misstatement. So once you know the risk, the next thing is what are the controls that is going to be in place. For example, the reconciliation control that we discussed. And then how the information is processed, which I explained previously, information system and communication. And finally, who is going to ensure that these reconciliations are really working in the organization, and that is the internal audit part. So this is a very hot topic, that has been tested in several past papers. You may not be aware. Look at the past papers. So 2 times the examiner has tested, apply the COSO framework to the case study. Now here examiner has 2 possible questions. One is this learning outcome. Evaluate how significant business risk. 6 marks, 10 marks. Can you write this for this case study? One answer I explained to you, revenue recognition. How do you write? Also we discuss, right? There is a higher inherent risk of revenue overstatement, effect incompleteness, cutoff, and accuracy assertion due to bullet points, large volume of repeatedly කියන්නේ ලියන විදිහ හරිම වැදගත්. The way you write matters a lot, right? Then if examiner asks this question, again theoretical question, no? So I told you LOs not tested can be tested in last 2 examination. Demonstrate the use of financial statement assertion by management, your knowledge about application of assertion, identifying potential misstatement. Now this also we discussed, that is your assertion knowledge. That's where here I explained to you completeness, cutoff, accuracy, right, for in relation to revenue. And then at the same time, how you apply the accounting standard. That is where additionally this, I have another slide, in revenue, we will discuss, and I'm sure Dasun will discuss in extensively this issue of what are the multiple components, the bundling and unbundling in telco. You can Google and see. That's a significant area of risk. How do you separate certain performance obligation? Now we will see, for example, how Dialog has done that. And this is why in the case study, examiner has beautifully captured this. And let's see how auditor has looked at it. We will see now during next 5 minutes. The issue that we discussed. Complexity is a keyword. Complexity means IR, right? IT system, billing. See these words that I use, large volume, right? And then the other reason for complexity is various pricing model. Because when there are new product and different tariff regimes, especially when there are, roaming charges involved. And then in telco, remember interconnection charges. If you look at so interesting case studies, WorldCom. WorldCom is a giant telco corporate failure. The revenue recognition manipulation and how they accounted interconnection charge as an asset in the balance sheet. Now revenue has to pay. And now, for example, if Dialog is using others network, and obviously you have to use when you go to another country, now you see roaming, Dialog is using some other service provider. Now that interconnection charges, in WorldCom case study, there was a fraud, and that what is going to the P&L, they have capitalized, right? So likewise, revenue, telco is an industry which is very complex. That is why even those frauds took place. Different revenue recognition policies. Now the other thing is the different policies, right? How, whether you want to revenue, now the deferred revenue at the month end, now there are prepaid card not consumed. So then can you recognize that entire revenue, or you should defer, right? Over time, or at that point, are you going to fully recognize, right? This we discuss. And now if I get into the accounting standard application from Dialog perspective, it's very important. Now remember, I'm going beyond corporate governance to accounting standard, because your paper, the risk of misstatement is linked to accounting standard. If you don't apply the accounting standard properly, there is another risk, right? So that's why that inherent complexity leads to difficulty in applying the accounting standards, especially see these bundle packages, how they deal with it. This is from Dialogue Annual Report. If goods or service is separately identifiable from other items in a bundle package, right? If a customer can benefit from it, right? The group and the company recognize revenue for individual services separately. If that customer get a benefit separately, right? Now, are there examples for this? So somewhere they have said this. Let me show you that. Now, say this area, for example, pay TV and fixed broadband service. Each subscription to a contract, right, is a distinct service. So if customer subscribe, that revenue is separate. That are substantially the same and have the same pattern of transfer to the customer, right? Then the providing of set of boxes, router, right, and connection fee, right, exclusively for the exclusive use of group services do not represent distinct service, and therefore they are to be combined with subscription service. Now subscription, they are combining with these other things and recognized as a single performance obligation. Now this is a judgment they are exercising, right? Are you able to challenge this? Now in exercising this judgment, the thought process behind, is it justifiable in applying the standard? So the whole point is what you can write in an answer, right? The revenue, only this sentence you have to write. The revenue recognition, application of SLFRS on revenue recognition 15, application of the standard requires significant judgment. Underline the word significant judgment and give an example as to how you decide to separate certain performance obligation or combine by looking at the economics, characteristics of those transactions. Very important, that's all you will write. So that's that. Because of that judgmental element, the inherent risk is high, right? So one of the characteristics of inherent risk is significant judgment. The more judgment is high. That is why in your case study, auditors have highlighted this as a CAM. And if you ask from auditing standard, now I'm taking auditor's hat. Auditing perspective, ISA 7 or auditing standard number 701, the key audit matters, right? The key audit matters arises from significant risk. One source of key audit matter is significant risk. Second source is significant judgment. Now, in that way, auditors identify, this is in dialogue report, how, why, even this way you can write your answer also, right? This really helps you to write answer on revenue recognition risk, right? See, revenue recognition, right? Complexity, inherent nature of the revenue, right? So they are here talking about accuracy of mobile revenue, right? And I also mentioned to you the completeness assertion. Now here, see the amount, 1111.5 billion, right? These revenue which are coming from all of these services. Why risk is high? This is what is important even when you write answer, simple bullet points like this. Why it is high? One is multiple elements arrangement inherent to the industry. So multiple element is an industry related business risk, right? It's a business risk. And then the question is how the revenue, the complexity of systems and the pricing model which we discussed. The same thing in your case study also, the examiner has used similar words. You can see these words, what I highlights are there in the case study, and this is from audit report, dialogue. And then a large volume of data we discussed. Now look at from auditor's perspective. Now for you, this is not auditing, but what is important is auditor is first testing when there is a risk company's control. As a CFO, you should be well aware about to counter this revenue risk. What are the control that I have in terms of my, say, COSO framework? One is what we discuss is IT system design, right? And those controls are working, specifically ITGC and application control, right? And then how you capture and record revenue transaction. Now they haven't mentioned here the reconciliation, right? In this capturing process, reconciliation is critical. And then if there are rate changes, how authorization works. Remember, authorization is a control activity in the COSO framework, right? And then these are audit testing. Now we are not talking about auditing, no, not very relevant. And especially journal entries, who approves journal entry as an internal control, critical, because if there are revenue leakage, where do you park journal entries? Who is reviewing revenue related journal entries? If examiner is asking you suggest 3 internal control, you can talk about evaluation of ITGC and IT application control as one, and then the reconciliation process, the robustness of the reconciliation process from Swish to CDR to accounting system, billing system to accounting system, right? Number 3, the authorization of system changes, specifically rate changes. The controls are in place, audit trails are being reviewed, and internal audits are being done on these areas and reported to audit committee. Those are direct answers that you can write if examiner is asking you recommendation on revenue recognition, right? I hope we have discussed enough about revenue. And then the case study, the other issue, if you look at the balance sheet of this company, right? Now, what can be these intangible assets? Now, we'll go to the case study and look at the balance sheet, right? What are the risks with high inherent risks? Right? Now, if you want me to mark the risk from a risk of misstatement perspective, yeah, that's fine. So now one is, what is included in these intangible assets at a group level? Can it be the goodwill? If so, remember an actual case study also, because when they merge with say acquisitions or merger pass, right? Say Airtel. Now there, the goodwill, even I'll show you the actual companies, how they are treating. Specifically, goodwill impairment is a key risk. Please write. Why goodwill impairment is key risk? Because you cannot just impair goodwill. You have to exercise judgment in identifying the cash generating units to which goodwill is applicable and allocate them to respective CGU, and then only you have to do the impairment. So then the key word is the judgment involved in identifying the CGU, right? And then when you want to do a value in use calculation, for example, again, the risk of underlying assumption about your revenue growth, discounting factor. Therefore, there is a higher inherent risk that the goodwill impairment, right, may not be properly done. And there will be one of the keyword you will use is management bias in the calculation, right, with respect to those significant assumptions. So that's another area I will show you again in my presentation. For example, if you look at goodwill, this is how auditors have looked at goodwill in the actual company, right? Now, business combination arising from acquisition of Airtel, right? So they have 100% acquired. See, during 24, the recent transaction, right? And how they have acquired through share swap transactions. And as a part of this, they have recognized goodwill of 14 million, right? Representing the excess purchase price over the fair value of net asset acquired. Now, at that time of fair valuation, for example, remember goodwill fair valuation also involves what? Fair value of identifiable assets. Now, imagine if there are some customer contracts as intangible, they have valued as a part of this identifiable assets. And the second thing is assume liabilities, not on the balance sheet, but you assume even contingent liability comes in. So that's where you apply SLFRS 3 properly, right? So that the fair value of assets and liability acquired. Correct words are those, right? Fair value of identifiable assets and assume liabilities, right? Then you do that. Now see, the key thing is what they say here, we consider, now this is why even when you write answer, these are the keywords, let me highlight them. There is the highlight. Oh. Now look at this. Here. Right. These words that I highlight, right? Now when you write answer, these words are critical, right? Judgments, estimates, and assumption that may have a material impact on the fair value of assets and liability, right? Now, some of those include, see, licenses identified as intangible assets. Now, see, now some of those. And then those are the most significant to the auditors. Why? This word is a key word and it's really great if you can use in the exam if you're writing wrong. What are the words? Estimation, uncertainty, and judgment. Now, these words are there in the Fair Value Accounting Standard, SLFRS, as well as in Auditing Standard, right? But we are talking from financial reporting perspective, right? And that is why auditors are specifically looking at those judgments involving the transactions, right? How they are using the valuation specialists to review the valuation methodologies and specifically significant assumption and judgment. So now two answers you can write for if examiner is asking risk of misstatement. One is a revenue recognition, second one intangible assets, including specifically talking about goodwill. You can talk about goodwill impairment, because again if I show you how say example now dialogue goodwill, how they are planning to impair, see this, right? Impairment of goodwill, right? Now that the first challenge is to properly identify all the CGUs, right? Now again, now, how do we really know that the CGO is the smallest? Now, they are considering all the applicable CGUs, right? Now, here following CGUs, the lowest level of assets, right? Which are separately identifiable. Cash flows are there, right? Where they can allocate the carrying amount of goodwill for impairment testing, right? Now, is it consistent with their segments? For example, when it comes to segmental reporting is another financial reporting standard, you can see what are the revenue segments and are these consistent with segments? So are there additional CGUs which they have identified, right? So that's the importance of goodwill from a risk perspective, right? So now I have given you a good coverage when it comes to the risk of misstatement, revenue recognition, and then, yeah, this we discuss, and this also we discuss, goodwill we discuss, and yeah, this is impairment of goodwill, right? Now, goodwill, when I explain to you impairment of goodwill, right? Now, what are the keywords that matters again? Now, here you can see impairment, management assumption and judgment about future results, specifically discounting rates, right? And the future cash flow forecast, because those are subject to uncertain future outcomes, right? And that is where this key assumption, discounting rate, terminal growth, are really to be benchmarked against the publicly available data to assess the reasonableness, and that is really a high risk from a risk of misstatement perspective. So goodwill impairment is a separate definite topic that you can write as a higher ROM, because remember ROM is a 25%, 20% of your syllabus, right? Specifically, and those chapters you have to read. Then the other one, from a CFO's perspective, that 20% of syllabus, I am still talking from your case study. Go to page number 114, right? Uh, uh, And again, sorry, I'm taking this from dialogue, and I think your case study as well. Your case study talks about somewhere, when I show you the case summary, they talk about this digital transformations and data, customer data, that type of information. Right now, from a risk management perspective, if you look at companies like Dialog, see, this is another area of risk, legal and regulatory risk, right? Specifically, when they deal with some countries where there are regulations about the vendors that you are not supposed to deal with this sanctioned companies. Now, in some countries, these certain vendors are sanctioned. You cannot deal with it, and there are liabilities if you violate those when you deal based on the business. Now, that's why this legal and regulatory risk is applicable. And then, yeah, this is the same thing. The other big risk is cybersecurity and data privacy. Very important from corporate governance perspective, students. I will ask you because I'm going to show you possible exam questions at the end. So the cyber risk is another area. Then another business risk that you can definitely write in the exam is the technology change, because the telco technology is highly rapidly changing. The rapid change in technology may result in impairment of assets and liability in the financial. See, for example, in dialogue, even in this case study, implementation of new submarine cable increases redundancy, right? So how it is impacting asset impairment. So asset PP impairment is a big topic driven by technology. The business risk is the technology change. The risk of misstatement is impairment. Again, please write. So I would like to give you now, if this question, if examiner is giving you these questions to you, examiner can directly give this because it's a yellow. Evaluate how significant business risk. Now we spoke about the complexity in the business leading to a business risk, and then we already spoke, say, example, fraud risk, and then cybersecurity risk. Can it impact financials, right? Cybersecurity. And now we spoke about technology change as a business risk, how it is impacting. So there are multiple ways that you can look at. So overall, the way you should look at risk is from an enterprise risk perspective, right? Now again, look at, this is dialogue. What are the top risks they have, right? Number 8, the top risk, one of the top risks where they give 24 score, right, is risk number 8. What is risk number 8? Cyber risk. That's why cyber is such a hot topic. Now, out of this risk classification, right, this is ISO 31,000, right? The enterprise risk management process that they have the risk management principle where risk management is integrated to the business, dynamic, customized, done with the best of information, right? So these are the principles, and there is a framework that is designed by the company, implemented, that framework is checked and improved and is integrated. This is called the risk framework. And the risk as a process, this is also similar to COSO framework. Risk as a process start with assessing the risk, right? First, do a risk assessment, identify risk, analyze the risk based on the impact and likelihood that is here, right? So the likelihood, here likelihood, the impact of the risk, and then what are you going to do about risk and report the risk. And then when it comes to reporting, from a risk of misstatement perspective, can you analyze this and say, this is impacting my financial statement? Cyber risk, right? Technology risk, how governance and ESG risk can impact financial statements, specifically from S2 perspective. Right now, S2 requires financial disclosures, right? So that's very, very important. That's another angle. Now, if you look at pilot paper examiners issue with the syllabus change 2 years before, has given this type of thing. And then look at how it is impacting the financial statements, right? So with that, if I move on to Another area, remember, please write the next risk is forex risk. Why forex risk we discuss? Because they have foreign operations, they have assets denominated in foreign currency, and they have to make payments, all of that. Hedging is an important area which I mentioned to you. Now, specifically from accounting standard perspective, SLFRS 9. Now look at in dialog balance sheet, right? They have this fair value loss, right? 4.3 million, right? The company has recognized following derivatives as financial instrument. Right now, the question is, let us say in the case study, I don't know the hedge accounting now. I'm talking from accounting standard point of view. Now, from governance to accounting standard, and again, this can come as a risk of misstatement topic. Hedge accounting, right? Now, hedge accounting not properly done, and you have parked this derivative in derivative gain or loss in the OCI without following hedge accounting. That is a misstatement. Derivative should go to P&L, fair value through P&L, unless you use hedge accounting. Now, hedge accounting cannot be done. You see here, under this is from dialog again, under SLFRS 9, derivative qualify for hedge accounting only if this is very, very important, right? Number one, they have to have a documented hedging relationship and the risk management strategy. This is the relationship. For example, this is the currency risk, right? That we are going to manage with the hedge instrument. And that your hedge, for example, is it now if it is a currency risk, it's a forward contract, right? Now, how do you know this forward contract is highly effective, right, in mitigating the exchange loss, right? Or if it is a fair value hedge, how effective in mitigating the risk? So, and have you tested that? Effectiveness can be reliably measured throughout the hedging period, and hedge item, right, and hedging instrument, which can be a derivative, are clearly identifiable and clearly linked. Derivatives that do not meet hedge accounting criteria are classified as held for, and I told you it's in the P&L. Now that, look at the accounts and ask, is there anything on hedging in the OCI? Go and check. And be aware if company is going to use hedge accounting, the implications, right? And now, yeah, the other question that examiner may ask you, advice. Remember what I am talking now is not limited to pre-scene. I told you in another 1.5 hours time, I will talk about 40% of syllabus. How are you going to get? And specifically from pre-scene, how you use it is another question. The other area in your syllabus, there is a LO you don't know sometimes. Go and read. There is a new learning outcome added subsequently to the syllabus about structure in risk management responsibilities. Who is supposed to do what? Take revenue recognition example we said. Now, who is the first line? Who is responsible to ensure that the revenue process works? Is it that revenue assurance accountant or an engineer in the company? Who is the second line? The accountant may be the second line doing the reconciliation. Who is the third line? Third line can be the internal audit, auditing the process. So that very, very important. You have to have that understanding. For example, in dialogue, how the risk management control works, you see, there are risk owners who are at the ground level who will actually assess. For example, the revenue leakage, that department will look at that risk and they will report and identify all of that risk, right? Risk owners, and there are risk owners who will support the risk process. They are called co-owners. And then there are risk champions, right? They are the single party to talk about risk management. And then internal audit. See, they are connecting internal auditing. There may be probably third line, and how they are checking the effectiveness of the risk process, right? So then this structure is very important. Now see, I explained to you 3 lines. This is there in your supplement also. You don't know what is a supplement, right? Supplement means with the syllabus revision, the new guidance added talks about 3 lines model, right? So like I said, the first line, the risk owners and co-owners are the first line. And the risk management function can be the second line. Internal audit can only be the third line. Why? They are independent, right? So that is that. And remember, this examiner has tested several times. how can you apply COSO framework to this question? Are you ready? Right? If the question comes in, this is a 3-line model which I explained. Don't say 3 lines of defense. That's old. And our new model is called 3 lines model. The first line, second line, third line, and reporting to the board. And the COSO framework, you need to have a very good understanding. In some exam papers, I think last paper examiner asked about control environment. That is only this piece about these 5 things. How do you apply to the case, about the code of conduct, whether the board of directors are independent. Right now, actually, in this case study, this seems to be good. Control environment. The risk assessment, we discussed today a lot about risk assessment. We spoke about technology risk, cyber risk, revenue leakage, all of that, ESG risk. And we also spoke about controls that need to be there, right? And then information perspective, you know, I explained to you how information is passing from Swish to CDR to billing system to accounting system, how journal entries are passed, and how internal auditors worked. And so now if examiner asks you, evaluate the control environment, right? Are you able to write the answer? Another thing is you need to be aware, the new corporate governance code talks about risk committee, and your case study says they have both audit and risk committee together. That's fine. See, listing rule says if company do not maintain separate committee, right? So this can be combined. That's similar to this case study. And this is another hot topic, students. Please be aware for your case study, cybersecurity risk management, right? So there, specifically, you must see if this question. Now, I am asking as an exam question. Explain the oversight role of the board of directors on cybersecurity. Please write this question, right? And also, I will finish in another 10 minutes. Please use the chat to ask questions. Antimata question ahla nikan balan indala yanaවට වඩා හොඳයි. Now if you ask questions, if you have, and I hope session is useful. So my theory is less more. In your personal life, remember students, less more is very, very important, right? Extremely important. What is less more? Because life is anyway less. You can count how many days we live. Right? So are you going to, how long you are going to spend to be a chartered accountant? 5 years, 10 years, 15 years, or 3 years? Less more. Because you will realize one day that becoming an accountant is, while a big dream, after achieving, what is it, right? That's the life. But don't waste life only for material things. The life is much bigger things, no? Because suddenly, remember the incident that happened 2 days before, no? How many people did they ever think they will die, right? Those who are traveling to UK, right? Is very short. So, less more. That's why I want to do 1 hour maximum, right? When you study also, study 1 hour. In that 1 hour will show I will score 20 marks during this 1 hour. පාඩම් කරනකොට prepare වෙනවා in a very strategic manner. Sometimes you can totally waste 1 day, but you can't score even 1 mark. Very poor study strategy. Be a very strategic student, know what matters and learn, right, in a way that matters to score above 50. So please ask if you have any questions, right? And yes, I can share the presentation, no problem. So ask any questions now. And I will finish in another, how many minutes? 10 minutes, right? Because I told Dasun you can start at 10:30. So can you suggest which areas should focus on S1? I really like that question. S1 and S2 will come. There's a greater chance. It came last time also. And it is an open book, right? That green color book, have it and underline key things that can come in the exam. So let's spend that time. Anyways, plan for the presentation. I'll quickly go there and ask any other question. So if examiner cyber is specifically how organization identify cybersecurity in terms of their business model, because dialogue business model is such that their cybersecurity is very high. Why? Because they are all operating in IoT world. And that is clearly given in the question. Any possibility of coming listing rule? Yeah, definitely. Because listing rule all goes together. Corporate governance, listing rule. When you study now the listing rule recently, revise. So therefore, please, yeah, I will tell that also in the next 10 minutes, right? Okay. Then this having a CISO in the company, having a cyber policy, and that policy has to cover the process of cybersecurity risk management, how incidents are identified, how vendor management systems are monitored, DRP, the governance structure, have you ensure cybersecurity, right? These are very important area from cyber perspective, and I'm taking this slide from where? Open book, page number 40 to 43. That is why open book you have to read well prior to the exam, right? Then, so there's a question about inside out and outside in. I think from sustainability perspective, now I'm doing another session at CA today, mock paper at 5 o'clock. Please join. There, I will cover sustainability also in some detail, especially this outside in, inside out can be addressed. And other questions from corporate governance, how you evaluate if now these LOs are very important now because examiner can decide to test one of these LOs, right? The board, how you evaluate the effectiveness of the board in terms of the board responsibility from corporate governance code, the board performance and conformance role, right? These roles, those you need to be aware. And the listing rules specifically, students, recently issued and applicable from specifically some are from 24 October. This is a hot topic again in Sri Lanka, right? Because the new listing rule has certain new changes, right? Specifically, it requires company to have set of policies. And one such policy is ESG, right? Risk management policy. If they don't have it, whistleblowing policy. So this policy framework need to be there, right? And then the listing rule specifically talks about the board balance, CEO chair, you have to split it. And if you don't split it, you have to have a SID who is very powerful, right? And that you are really making sure that SID is independent. The board diversity is specifically discussed in the listing rule, right? Whether diversity is adequate. And then you can have conference meetings are recognized. And specifically for listing rule, remember this hot committee for your syllabus is audit and risk committee, which we already discussed. At least 3 directors, 2 should be independent, I think, for your case study. But if corporate governance is tested separately, this is very important for you to go through specifically. And now the toughest thing in listing rule, now if you have audit committee should have specifically chairman should have a qualification in finance. Now, good job for chartered accountant in future, right? That's the new change. And then 13 areas of responsibility specifically for audit committee, right? Those areas you need to go through. And then, and this point we already discussed, whether to have a separate risk committee or combine. So that's possible. And last, it's very important to note that if you are a listed company, you can actually, the parent company's audit committee can serve as the audit committee of listed company, right? And again, I told you I'm doing a session today. You can attend, right, at CA. And there I will talk more about sustainability. But if you ask me what examiner will test, we can easily guess. No, examiner can test one of these. Why? Because they are the learning outcome. So out of that, what is possible to come in the exam? Right? Now, what examiner already tested was this last paper, right? Transitional relief. Everybody must know because this year only we are applying the standard. December clients are applying. And Telco is December, right? But your year end is not December anyway. They forget that 25 now. If they are applying the standard, what do you understand by paced approach? Right? And then transitional relief, how you use it. So specifically, standard allows you difficult areas in your first standard is S2, right? Difficult areas like scope 3 emission reporting, right? And quantification of financial impact, those there are relief given. So that's transitional relief. And there is a slide which you can go through on that. So this was tested already. The other area that can be tested is things like that. Climate risk, you know, how physical risk, transitional risk, and the financial impact to be reported. And then from corporate governance angle, sustainability can be tested. What is the board of directors' responsibility about SRRO? See this word oversight role of the board, right? Because the standard specifically requires, and it is there in corporate governance code also. What is the board responsibility? Please go through corporate governance code under ESG. What board is? Again, I have a slide here. I can include that. And then the other area is, now see, even if you look at dialogue, they are using GRI standard. They are also using another set of standard. They are SASB as well as another set of standard. I forgot the name, the applicable to telco industry. And with that now easily they are applying IFRS also, the early adopted. I mean not IFRS, SLFRS, S1 and S2. So now you need to have a knowledge, and not only that, integrated reporting again applied. So this say dialogue annual report, one of the exam question, examiner asks you to explain 6 capital, one past paper. Now this area, that's why student, this 40 marks you should be able to score and get the prize, get above 70. Passing is nothing if you target that, right? So now if you're asking me what examiner can test, one of these, no. So then how you should prepare for this, right? So that is where you need to really look at the standard and go to S1 standard, and there is one paragraph about board of directors responsibility. 5 things board of directors should do. Start with how board is going to identify SRRO. I mean, how the board is, one is there a board committee looking at this? Which committee is looking at this charter? Right? How board is going to get information about SRRO? Right? How board is going to get the knowledge about this? Like that, 5 hows are there. How? Right? So that paragraph is very, very important when you prepare for this LO. Now see, now less mono, even in S1 and S2, big book and a huge knowledge, right? How can you study if you can't spend 1 month? No. So less more strategy you have to use, right? And so that is sustainability. And the second one I explained to you, basically the connectivity with SASB standard. Specifically, SASB has the topics which suggest that these are the SRRO, right? I can't actually fully cover this in 5 minutes, but I am telling you in terms of preparation, you target these learning outcomes, right? Now, the point here is that if you are doing GRI, remember GRI is stakeholder framework. Whereas S1 stakeholder framework means you are looking risks which are not relevant to now. That is the question of outside in and inside out, right? Now the stakeholder means what company is doing, how company's activities affecting the others. So that is what inside out. But sustainability S1 and S2 is how outside is, how the climate change is affecting you. That is a financial materiality, right? Financial materiality and impact materiality. So GRI framework is about impact materiality, whereas S1 is outside in, how climate is impacting the company's cash flow, right? Now dialogue, if you look at now here, I have a slide. See how they have identified assets, the outside in, which assets in the balance sheet are at risk. And this is what you must know, quantify. For example, there are towers, data centers, underwater cables. They are at risk due to climate change. 3%, 2% likewise. And then when it comes to risk reporting, this is what you should know, right? Now they have to report the impact on the cash flow and the accounts, the impact of physical risk, right? Now physical risk, acute risk and chronic risk. Now suddenly there is a flood, you know, there is one somewhere, there is one day, entire day rain that is equal to several years of rain, right? That is in Spain. Like that, there is sudden environmental impact, right? So that's the physical risk, right? Now imagine now practically, now one of the tower which is in a mountain, there is some, say, due to extreme weather, this tower is going to be affected. Then after that, how they operate? Now that is exactly after that your revenue generation, everything gone, right? That's exactly how physical risk is impacting the dialogue, right? In your case study. See, while the network suffered some damage, they did not result in write-down of assets. They were restored with the cost of repair and maintenance. However, we have recorded the cyclone impact, where the total loss 13.3 million. The effect, see, this is a very good example. Significant risk of material adjustment, no impact, right? Extreme weather, short term, medium term, long term. Extreme weather can increase uncertainty. So like that, you can disclose, right? So now this year, the first year, you don't need to quantify. Right now, this is the best way you should study practically how they are reporting this physical and transition risk. Those are that is the S2 standard, right? And then the big topic, next big topic that you should know about S1 and S2 is about your scope 1, 2, 3 emission. This one you must know. This is a critical slide. That again, in 1 minute, right? Scope 1 emission means what you burn inside the company, right? You are using fuel for the generator, what you are burning, right? Your activities while you are processing, what you burn inside the company, facilities, right? Then if you purchase specifically electricity, right, or steam, right, or heating, that is scope 2. Scope 3 is your value chain, right? How about your suppliers' energy consumption, right? Likewise, the employee, how employees are going home also matters. Scope 3 emissions, right? There are 15 categories. Now, how do you actually quantify and account for carbon stock? That is the S2 standard, because you are supposed to report scope 1, 2, 3. Scope 3 you have a relief, and that has to be done based on the corporate accounting and reporting standard 2004. There is another standard you must know. This standard is called greenhouse protocol. See, S2 standard refers to greenhouse gas protocol to report your scope 1, 2 and 3 emission, right? Right. So I think the I told CA I'm starting the mock paper early, starting at 5 p.m. I hope you got that. Arun, are you on the call? Yeah, so the mock discussion is done. Yeah, I hope the session was useful. Are there any questions? Yeah. So I think CA will upload the session today. And any other questions before I close? All right. Thank you for your feedback. And remember my last thought for you. What? Less more. The less more really works when you are close to exam. Anyway, you have less, right? You have only few days, no? So few hours. How to get the maximum out of that, right? All right. So thank you very much. Wish you all the best, students. I will share my presentation also with the slides that I covered, right? So I hope it will be useful. And I have anyway put in this deck some of the possible questions as well. So my request to you is now write your answers and see whether it is examinable state. Thank you very much.
Good morning, students. Let me start the financial reporting aspect of the pre-scene analysis for your examination June 2025. So here in this particular presentation, I'm going to cover the presentation in 4 areas, right? So the introduction to the company, that's a short section. So thereafter the accounting standards, consolidation, and thereafter analysis and interpretation, say ratio analysis, right? So first of all, if I start with introducing the company, probably have gone through the pre-scene number of times and you would be aware about this. So because of that, I just summarize in a couple of slides. So the company is Singtel Lanka PLC. This is called as STL, right? So there are 4 main types of business that the company is undertaking. It is in the telecommunication industry. So the businesses undertaken are mobile telecommunication services, fixed telecommunication service, then mobile broadband service, and digital pay television services. So these are the main revenue streams or the business segments in which this particular company operates. So we need to go into detail and analyze what are the implications of each of these business sectors. So then if you look at the share capital of the company, the number of shares are 2000 million or else 2 billion. So then value per share is 10 rupee and the total value of the share capital is 20,000 million or 20 billion. Okay. So now in this particular pre-scene, examiner has given you the timeline. I have taken the same timeline what is given in the pre-scene, highlighting the key events which have been taken place in terms of this particular company, right? So the company was initially established. Company was initially established in 1999 as a private company, but the commercial operations have been started in 2000, year 2000. So thereafter, the company has acquired STL, or this particular company has acquired 2 more subsidiaries, right, which I will present in the next slide in detail. So one particular subsidiary is actually undertaking the fixed telecommunication work, fixed telecommunication service. The other one is satellite TV network. So 2 companies have been acquired in year 2017. So which means this is a group. Okay. So that's why STL is preparing the consolidated financial statements, including the parent company as well as 2 subsidiaries at the moment. Then the company was listed in Colombo Stock Exchange in 2019 and 2023. So this particular company has become the largest telecommunication service provider in Sri Lanka, right? So by looking at the details, information, we can probably aware at this moment, more or less, this is similar to Dialog, right? So because of that, what I have done is I have taken certain extracts of the annual report of Dialog as well to deep dive into the pre-scene and analyze the case study. Okay. So moving on, the group structure, right? If you look at the group structure, so the company that we are talking about mostly is about Singtel Lanka PLC, STL, right? So if you look at this particular company, that is actually a subsidiary of the parent company, a foreign parent company, Singapore Telecom PLC, right? This Singapore Telecom PLC has actually 80% ownership of STL, right? So then the remaining 20% holding of STL initially held by a person called Lionel. He was the initial CEO as well in the company. But now this is a PLC. PLC means public quoted company, which means definitely there should be a public holding. So no information has been given about what has happened to the Lionel's holding after the initial incorporation of the company, but definitely for sure, certain percentage now it has to be held by the public because this is a PLC. And also as it is a PLC, So definitely full SLFRSs are going to be, or full SLFRSs are the one which is going to be applied for the company. So because of that, actually, we don't need to worry about SLFRS or SME standard application of that standard SLFRS or SME for this particular company in terms of the pre-scene analysis. Okay. So as I mentioned, 80% of the holding of the company is held by Singapore Telecom PLC. Then this particular company, as I mentioned earlier, in 2017, right, STL has acquired 2 subsidiaries. So if you look at these 2 subsidiaries, in the first one, that is Payphone Private Limited, STL holds how much? 90% of the share capital, which means 10% of the share capital is held by the outside shareholders. So this would be called as PPL, right? In my discussion, I will refer this as PPL, right? PPL. This is STL. And also STL acquired 100% shareholding of Vista TV Private Limited, okay? VTV. So basically, VTV is into the digital TV service providing. And this has to be, because it was mentioned, one company is into satellite TV network, the other one is into telecommunication, fixed telecommunication services. In addition to that, this particular company provides broadbanding services as well. So the 3 companies, what we need to mainly focus in terms of the case studies, STL, PPL, and VTV. Okay. So, but remember, there's a parent company for STL where 80% of the shareholding is held by Singapore Telecom PLC of STL, right? So that is about the introduction part, which you probably be aware by now, but I just wanted to give an introduction before we analyze in the case study or the pre-scene in detail, right? Now what we are going to do is we'll be looking at, first of all, the accounting standard section. What are the accounting standards which can be tested in terms of this particular pre-scene analysis? Then thereafter, we look at consolidation. That is the most important area, right? Because the consolidation question carries most of the marks when it comes to your paper in terms of the unseen. And also at the end, we'll look at ratio analysis as well, because in this particular pre-scene, there are some ratios given. And also constantly, if you look at the recent past papers, examiners tested in terms of the ratios, especially the DuPont analysis. Okay. Right. So what I'm going to do is I'm going to look at every possible, each and every accounting standard which can be tested. Definitely for sure in your examination, examiner will not test all these things because he just have only 50 marks, right? There also, he has to allocate certain marks for the risk governance and ethics part as well. So, but what I would do is I would discuss all the accounting standards in detail, right? So even if it is not tested in the question number 1, that would be useful for the other areas, or basically other questions in the exam paper, right? So moving on. So I'm not going to go through the pre-scene word by word, para by para, because it was given to you sometimes back and you already read that. So because of that, I'm highlighting only the important aspect of the pre-scene where it is applicable for the financial reporting aspect of this paper, right? So first information, what is given in the pre-scene is, right, information technology. This is actually a para taken directly from the pre-scene. So information technology serves as a backbone of the modern telecommunication, right? PPL, that means this particular company, Payphone Private Limited. PPL was acquired to invest significantly in technology to improve its customer service and upgrade its broadband infrastructure to top-tier standards. So the purpose of acquiring the company. However, securing a substantial amount of additional capital while maintaining an optimal capital structure proved to be challenging task for PPL, right? So when you look at this particular para, when you read that particular para, so what standard that it would come to your mind, right? So in this particular pre-scene, actually, there are, I would say, limited information given in terms of any impairment assessment, impairment loss recognition, right? But if you look at, because we look at the financial statements in detail later on, but if you look at the financial statements of STL, right, you will see that there's an impairment loss recognized in the P&L. But it can be for asset impairment, that means long-term asset impairment like property, plant and equipment, or it can even be with regard to an impairment of a financial asset like trade receivable, which you don't know, right? But only indicator in terms of the impairment in terms of this particular pre-scene is that this particular para, right? Because this telecommunication means technology driven, tech driven company. So one of the impairment indicator what we see in the standard, because standard provides you few examples of the impairment indicators. No? One of the external indicator is technological obsolescence. Now this particular company, it was mentioned that it's a bit of a challenge for the company, because why? Every time once the technology changes, you have to invest more and more. For that, you have to raise funds. If you do that, there won't be an issue, because whatever the technology, where it is, once it is getting changed, if you invest in a new technology, then there's no issue. But if you don't do it, what will happen is the competitor would come up with a better technology. Your technology, the technology that you use, would be outdated. So then the asset relating to those can be impaired. So in case if such a situation is given in the unseen, what you do is you have to do because what the standard says is, first of all, look at whether impairment indicators are available. If there are no indicators, no problem. But if the impairment indicators are available, you have to go for the next step of what? Testing the impairment of that particular asset or of that particular cash generating unit. So applicable standard is actually LKS 36, impairment of asset standard. So how do you do the impairment testing? If the indicators are available, you compare the carrying value with the recoverable value, right? So the recoverable value means higher of fair value less cost to sell and value in use. Out of these two, you take the higher value as the recoverable value. Then you compare that with the carrying value. If the recoverable value is less than the carrying value, what you do is you need to recognize the impairment loss. If the recoverable value is higher than the carrying value, you don't have any issue, right? So just wanted to highlight this particular point as there's an impairment loss is there on the profit and loss statement. But as I mentioned, it can even be with regard to impairment of financial assets, which we'll look at, right, once we go through the financial statements in detail. Right, okay, then this particular information is, I would say, one of the most important information and one of the most important area in terms of this particular pre-scene, right? That is, just read and see that, okay, what is the standard that is relevant to this particular para? Company initially commenced its business to provide mobile telecommunication services, right? STL is initially for mobile telecommunication. But its product portfolio now consists of additional businesses, fixed telecommunication, mobile broadband services, and digital pay television service. I told you that when it comes to this group, there are 4 business sectors, right? So mobile telecommunication, fixed telecommunication, mobile broadband services, and digital pay television services. So different businesses means what? So you have to recognize the revenue in terms of each of these business segments. Now we know that in SLFRS 15, we have a model which consists of 5 steps to recognize the revenue. You have to apply the revenue recognition model 5 steps to each of these businesses to recognize the revenue. And also this particular matter was highlighted. Revenue is identified as a key audit matter in the audit report. So because why? There are there are 3 points given there, where I have only taken the point relevant to this particular matter in terms of the financial reporting aspect of the paper. What it says is different revenue recognition policies for rendering services over time and sale of goods, point in time. right? So there's a key audit matter saying that company uses for certain performance obligations, they are using the overtime approach. For certain performance obligations, companies using the point-in-time approach. So because of that, we have to deep dive and understand what is the approach or what is the method of recognizing the revenue for each of the businesses that the company is having. Okay. So obviously the applicable standard is what? SLFRS 15, revenue from contracts with customers. So where, there are 5 steps to recognize the revenue, right? So first of all, identify the contract with the customer, agreement to provide the goods and the services. Then identify the distinct performance obligations in that particular contract. Okay. So how many performance obligations are there and what they are. Thereafter, you need to determine the transaction price, how much you are going to collect from the customer. That is step number 3. Step number 4 is allocate the transaction price to each of the performance obligation what you have identified, right? That is step number 4. And step number 5 is recognize the revenue once each of the performance obligation is satisfied. So step number 5 is what is actually important in this particular matter. So to recognize the revenue, we have 2 approaches, overtime approach and point-in-time approach. Okay. So here, I'll move to straight away the annual report of dialogue after this discussion, right? After discussing the theory here. What the standard says is, so the first para says that I'm not going to read through because we have, like some of the theory areas have been included, but I'm not going to go through word by word. If I tell you the essence here in this slide, because you all can go through later on, I'll provide the, material. So what happens is there are 2 methods of recognizing the revenue. So at the contract inception, we have to decide for each of the performance obligation, whether you are going to follow the overtime approach or point-in-time approach. Okay. So if you select the overtime approach, right, we look at where do you to recognize the revenue by using the overtime approach. So if you select the overtime approach, you have recognized the revenue based on the progress towards the completion, how much of work is completed. So based on that, you have to recognize the revenue. On the other hand, if it is point in time, you have to recognize the revenue once you transfer the control, right? So particular point at which you transfer the control to the customer. At that time, you recognize the revenue. So the guidance given in the standard is, so first of all, you have to look at whether the performance obligation is satisfied over the period of time, right? So for you to say that the performance obligation is satisfied over the period of time, what you need to look at is, you have to look at 3 criteria. Out of these 3 criteria, if one criteria is satisfied, that's enough. No need to satisfy all 3. Out of 3, one criteria is satisfied, mean you have to recognize the revenue over time. Okay. So I'm not going to again go through all these 3 criteria. I would highlight what is important for this particular company. What is important for this particular company is the first criteria. So what is the first criteria? Customer is receiving and consuming the benefit of the seller's performance simultaneously as the seller performs. So in simple language, when seller performs, customer consumes. It happens simultaneously. So most of the services, what will happen is seller performs and the customer consumes simultaneously. So even here, when I'm lecturing, you consume the service simultaneously, right? So because of that, actually in this particular company, most of the performance obligations are satisfied over the period of time because of the satisfaction of the first criteria. So what I did was actually, so before moving there, I already told you, now let's say these are the 3 things that we look at. If one of these 3 things are satisfied over time, if none of the 3 criteria are satisfied, which means you have recognized the revenue by using the point-in-time approach. Point-in-time approach means the point at which the control is transferred to the customer, right? So before moving to our analysis, I actually included, this is directly taken from the annual report of Dialog Axiata PLC. So 2024 annual report. So it is actually a December end company. Okay. it's a December-end company. So I have directly taken this from the annual report of Dialog, right? What it says, if you just go through this, so this is note number 26 of the annual report, financial statement section. Group and company derive revenue from transfer of goods and services over time and point in time through following business lines. Okay, so there are point in time as well as over time. So first of all, the revenue split of the company have been categorized into 3 areas. Mobile operation, that is actually the mobile telecommunication mainly. Then fixed telephony and broadband operation. So fixed telephony and broadband, they have taken together, right? And thereafter television operation, mainly Dialog, pay TV, right? So revenue of each of these areas have been given. So the total revenue was 171 million, right? Then what happened was this particular revenue is split. How much is under point in time and how much is under overtime? So if you look at out of this total revenue, majority of the revenue is basically overtime, right? Very limited amount of revenue is point in time. Actually, what is coming there under the point in time is things like devices sale. If you sell devices to the customers, right? So in that sense, what will happen? It is point in time. So you have to recognize the revenue once the control is passed to the customer, right? Other than that, so the most of the revenue, I would say 99% of the revenue is coming under overtime approach, right? In addition to that, in this particular revenue note, so there's another statement. The details of the restatement of the group revenue reported for the year ended 31st December 2023 are provided in note 38. So now let's say if examiner or the person who has, who is setting the paper, if he has, like once he's going through, if we just look at this note, right, and if the question is asked from there, we have to be careful. Because of that, I will explain that particular note as well, because that is an important area. Okay, so what is this restatement? If you look at in 2023, there's a restatement taken place, right? So I'll explain that aspect as well. But before that, let's try to understand this first. Now, thereafter, what I did was, I went to straight away the accounting policy section of the company's annual report. Okay, so there are now under the revenue recognition, it's a very detailed accounting policy. I have taken what is relevant for your pre-scene analysis, right? So not the entire thing, right? So what it says is, if you go through these 2 sections or these 2 revenue recognition areas, so the first area is domestic and international telecommunication service revenue. Now in our pre-scene, there are mobile telecommunication service as well as there are fixed telecommunication service. So with regard to telecommunication service, whether it's mobile or fixed, the revenue recognition approach is same. Okay, what it says. Now what are we going to look at now? Whether the performance obligation is going to be satisfied over time or point in time, and what Dialog has done in their financial statements. Okay, so revenue from provision of telecommunication services such as call time, messaging, data services, information provision fees, connecting users of other fixed line and mobile network to the companies and group network is recognized when or as the entity performs the related services during the agreed service period. What it says, in terms of the telecommunication, mobile or fixed, company recognizes the revenue. This is actually the voice data, right? Mainly voice and data, as well as messaging. So the revenue in terms of these services are recognized when company perform the service, when company perform the related service. When company perform the related service, customer is consuming the service simultaneously. What will happen? So the revenue has to be recognized over the period of time, right? So customers are charged government taxes at the applicable rates, and the revenue is recognized net of such taxes. So when it comes to the price of the product, you include the government revenue. So, but government taxes, you don't take into the revenue because there is something that which you need to pay to the government. Okay. So the net of government taxes, the amount that you collect from the customer is recognized as revenue once the service is performed. So what is the approach? Over time. Okay. Right. What is the other one? Then the second point, what I want to take is each, now that is relevant with the pay TV and the broadband services. So again, so in this particular precinct, both of these services or both of these business sectors are included. Let's see what is happening there. So pay TV means dialogue TV, right? Then broadband services. Each subscription to contract for pay TV and fixed broadband service is considered as, so this is about the pay TV and the broadband. Each subscription to contract for pay TV and fixed broadband service is considered as series of distinct services. Series of distinct services that are substantially the same and have the same pattern of transferring to the customer. So every month you provide that service. So dialogue TV service, then the broadband service. It is what? Series of distinct services which are substantially same and which have the same pattern of delivering to the customer. The providing, this is important. Now, this is very important statement. Pay your attention, right? Providing of set-top boxes and routers and connection fees for exclusive use of group service do not represent distinct services or goods, and they are to be combined with subscription service as a single performance obligation. Satisfied, directly mentioned, satisfied over time, right? Revenue is recognized over the period the service is performed from the activation date of the subscription and as the service is provided, right? What it says? It says, if I go to the, by having this understanding, let me go to the next slide, and this is what is applicable for us, right? So I already told you with regard to mobile telecommunication service and fixed telecommunication service. So that is actually data, voice, and text messages. So where the revenue is recognized over time, because why? Seller performs the service and customer consumes the service simultaneously, right? So the fixed telecommunication services means, earlier I can give the example of CDMA phones, right? Now that CDMA technology is outdated, it has been taken out actually, it's no more there. But still, like telecommunication companies provide the fixed telecommunication services to the companies, corporates and all, right? So in both these cases, that is as per this first point, revenue is recognized over time, right? Thereafter, it's about broadband services and the digital pay television services. Here also, what as per the point number 2, revenue is recognized over time, because what will happen is, now they are even what is happening is, if you look at in detail, company provide the service and customer consume the service simultaneously. But there can be different payment patterns. It can be like prepaid or postpaid, right? It can be monthly rentals or annual rentals. Doesn't matter. That is actually payment types. And also there can be different packages, bundle packages, promotions. What we need to look at is, what is the revenue recognition? The revenue recognition always taken place when the seller performs the service, right? So at the time where the seller performed the service, consumer or the customer consumed the service simultaneously, so that the revenue has to be recognized over the period of time. Now, in terms of mobile broadband, sometimes what will happen is now company is giving these devices. So that is what is important, what I wanted to explain to you now. Now, in terms of, right, so the broadband, what company does is company provide these devices, and even in the digital pay television service, company provides what? Set-top boxes, as well as in terms of the broadband services, routers. So the company provides these things. Now you might have a question whether these are actually goods, no? This router, this set-top box, so those are goods. Now, when I'm recognizing the revenue, should I consider that as a separate performance obligation to the service or the broadband service and the digital pay television service? So should I recognize those as separate performance obligations? So that is an important area in this particular matter. Now, this is as per the accounting policy of Dialog, what it says. Now, for you to recognize something as a separate or distinct performance obligation, what you need to look at is, okay, whether that particular performance obligation, that particular good or service has a standalone value to the customer, which means customer can benefit out of that particular item on its own or else together with the other resources that the customers are having, as well as whether that particular item can be separately identifiable. Okay, so if so, we say that, okay, it's a distinct performance obligation. If not, it's not a distinct performance obligation. One of the criteria that you can look at is whether the company, whether practically what you can look at is whether the company is selling these items separately. Let's say whether they are selling these routers or else set-top boxes separately without the service, without providing the broadband service or without providing the digital pay service. Are they just selling these items separately? Now, if they are doing that, you can say that, okay, that means customer can benefit by using those items by its own. Now, according to Dialog, what it says is the Dialog does not recognize these set-top boxes or routers, even the connection fee, because when you are giving a connection, you charge something from the customer, initial fee to provide the connection, right? But this company, Dialog, does not recognize those as what? Separate performance obligation. Okay, whatever the revenue relevant to those items are taken into the what? Service revenue. It is a single performance obligation, no separate performance obligation, right? So because of that, at the time, now initially when you provide the connection and you charge a fee, and also you provide set-top boxes, routers when you provide these services, but at that time you don't recognize any revenue. Because why? It's not a separate performance obligation. It's part of the package. So if it is part of the package, what you do is you recognize the revenue over the period of time once the broadband or the digital TV service is provided to the customer. I hope you are clear about that point. But answering to our first question, even in these two cases, mobile broadband service or digital pay television service, revenue is recognized over the period of time. Okay. So is my voice clear now? Okay, great. Right. Thank you. So what I was explaining is very important point. Hope you heard what I have explained. Do I need to explain it again? Because it's a very important point. So do I need to explain it again? Okay, so what I was telling is actually right. So what I was explaining is now this company has this particular company has, as per the pre-scene, there are 4 types of businesses, right? Mobile telecommunication, fixed telecommunication, mobile broadband, and digital pay television services, right? So now we need to identify whether the performance obligation is satisfied at a particular point in time or over time. Okay. Now for that, what I did was I have done some research and I looked at the annual report of Dialog, what they have done. Okay. So with regard to the telecommunication service, in summary, what it's mentioned is you need to recognize the revenue when the service is performed. So which means the company performs the service and the customer consumes the service simultaneously. So because of that, the revenue has to be recognized over a period of time, over time approach. Right? So this is basically telecommunication services means voice, data, and text services. Right? Then, which means mobile and fixed. So in the case of like mobile telecommunication, all of you are aware what it is. Fixed telecommunication means earlier we had the CDMA technology, but now that technology is no more there, but still companies like Dialog provide fixed telecommunication services to the corporates and as well as individual clients. That is there, right? So the revenue has to be recognized by using the overtime approach. The other two are broadband service and the digital pay service. There, what it says is, yet again, right? So the revenue has to be recognized over time because on the same matter, seller performs the service and the customer consumes the service simultaneously. These are series of distinct services which are substantially same and it has the same pattern of delivering to the customer. Then the next question what we need to answer is, when you provide broadband service or even digital pay service, you provide certain goods to the customer like routers, then set-top boxes, and also when you give the connection, you charge a connection fee. Then the question is, okay, whether these items are to be recognized as distinct or separate performance obligation. So if it is a separate performance obligation, what you need to do is you have to recognize the revenue from the services separately and these items separately. As per Dialog, right, this is their accounting policy. What they did was they specifically mentioned that these are not separate performance obligations, right? Even they charge a connection fee, even they give these items like set-top boxes and the routers, they do not consider these as separate performance obligation, because for you to recognize something as a separate performance obligation as per standard SLFRS 15, it should have by having that particular good or service, customer should benefit by its own, or else together with the other resources that the customer has, as well as these items can be separately identifiable. Now, normally the criteria that we look at is to see that whether it's a separate performance obligation or not, whether the company is selling these items separately without providing the service, right? So now it seems that this company provide the service. To provide the service, they need this, like goods, like set-top boxes and routers. So because of that, what company does is company provide a full solution. And this full solution, the entire package you recognize as single performance obligation. You don't recognize set-top boxes, routers, even the connection fee, even though you charge a fee, you do not take that as a separate performance obligation. So the revenue attributable to everything, including those, you recognize as one performance obligation once the service is rendered. So that means you have recognized the revenue by using the overtime approach. So I hope you are clear about that particular aspect. It's clearly mentioned that the revenue has to be recognized over time. So in summary, so almost everything what we are given in this pre-scene analysis need to recognize the revenue by using overtime approach. Okay. But as per Dialog's annual report, they had something point in time, maybe because it has number of businesses. The group means what? It has number of businesses. So the company may be selling certain goods to the customer. Those have been recognized at point in time. But if you look at, the amount of the performance obligations are satisfied at a particular point in time is very minimal. Okay, right. Okay, is that clear? Is that clear with what I have explained? Is that clear to you? Because important aspect. Right, great. So then remember this particular point, right? Now, what examiner has done, he has given us a pre-scene, which is applicable for all 4 papers at the strategic level. Then what we did, we now look at, okay, by reading the pre-scene analysis, we assume that this is okay, similar to dialogue. He has not mentioned it is dialogue, no? Right? But by looking at the information, the history and the, other information, we can guess, okay, he has based this case study based on dialogue. But he might ask a different question in the examination in terms of SLFRS 15, right? Then we can't say that, okay, dialogue is doing that way, so that my answer is depending on what dialogue follows and what dialogue has disclosed in the accounting policy section in terms of the revenue recognition. So you have to read the scenario what is given by the examiner, right? Because examiner can construct a question in such a way where the particular contract has multiple performance obligation, right? So because of that, what I'm going to do now is I'll come here, right? I'll skip these 2 slides. I'll discuss this particular example and go back and discuss the 2 slides which I skipped. So what examiner can do is he can construct a question, okay, in such a way there are multiple performance obligations. So you have to look at the scenario and answer. But as a guide, I just wanted to give you the knowledge what this company dialogue is doing. Now just read this question. I have included a question. Very quickly look at why it says 1st January 2024. STL enters into 12 months telecom plan with a customer under the following terms. So what is the date of entering into the contract? 1st January 2024. It's a 12 months telecom plan. Monthly fixed fee to be 1,000 rupees. Okay, monthly fee 1,000 rupees. That is what you charge from the customer. Customer to receive free handset at the inception of the plan. Now you see, customer is given a free handset at the beginning of this 12 months telecom plan. Now the question is whether this free handset is a separate performance obligation or not, right? Now look at what examiner has told in this situation. Now, STL sells the same handset for 3,000 rupees. Here, what this company is doing in this scenario is STL sell the handset separately, which means customer can benefit from the handset by its own and customer can separately identifiable. If that is the case, if that is the scenario, it seems that in this particular scenario, you have what? 2 performance obligations. As I said that, so the examiner has never mentioned that I'm, looking at the dialogue and giving you the pre-scene. So he has given a pre-scene. So, but based on the information, we assume that, okay, this is similar to dialogue. So because of that, it doesn't mean that you have to do the same thing what dialogue has done. So he can construct the question differently, where your answer has to be based on what examiner wants. Remember that, right? That's why I'm doing this question. Now STL sells the same handset same handset for 3,000 rupees and the same monthly payment plan without the handset for 800 per month, right? Same monthly payment plan with handset 800 rupees per month. What is it? There are, so if customer wants, what this company does is, if customer just need the handset, sell the handset at 3,000. If customer just need the telecommunication service, only this monthly, so there's a monthly plan, just the price is what? 800 rupees. So customer can get the handset separately and the telecom plan separately. And there are separate prices, standalone prices are available for each of the item. On the other hand, if customer wants, what customer can do? Customer can get both of these, handset and the telecom plan, 12 months telecom plan, by paying how much? 1,000 rupees. So this is different to what the previous discussion that I had in terms of dialogue. So what it says, what is required? How should STL recognize the revenue from this plan in line with SLFRS 15? Here, the company sell these two items separately. It's kind of a guideline, practical guideline to say that customer has what? Distinct value of each of these two items. So that in this situation, this has to be recognized as distinct performance obligations. So basically in this situation, there are two performance obligations. By applying the 5 steps of the revenue recognition model that we discussed at the beginning, what is the first step? Identify the contract with the customer. STL has a contract to provide goods and the services. Step number 2, identify the performance obligations in the contract. How many performance obligations? 2 distinct performance obligations are there. One is telecom plan, the other one is the handset, because each has a standalone value to the customer. Third one, determining the transaction price. So what is the transaction price here? Now let's say what we sell is the bundle one to the customer. What we sell in this situation? What we sell? 12 months telecommunication plan where we charge 1,000 rupees and provide both handset and the telecommunication plan. So what is the transaction price in this contract? Because these are information, right? Actual contract that STL entered it to with the customer is 12 months telecom plan with the handset 1,000 rupees. So what is the transaction price? Transaction price is 1,000 rupees into what? Well, how much? Rupees 12,000. So that's why this is what? Series of distinct performance, series of distinct services. Every month you provide the service, series of services which are substantially same. Every month you provide the same service and which has the same pattern to deliver to the customer. So the entire thing you recognize. Now, if you look at the transaction price, what is the transaction price here? 1,000 into 12, 12,000. Right? That is step number 3. What is step number 3? Step number 3 is to determine the transaction price. So as per our particular example, transaction price is 12,000 rupees. Then what you do is step number 4, allocate this transaction price to each of the performance obligation. Now this 12,000 rupees, you need to allocate to telecommunication service and handset. So how do we do that? We'll look at. Thereafter, you need to recognize the revenue when each of the performance obligation is satisfied. Now you have 2 performance obligations. Now you should tell me. So tell me. So whether it is overtime or point in time. What do you say? Telecommunication service, overtime or point in time? Overtime or point, because you have 2 performance obligations now. You allocate the transaction price to these 2 performance obligations. How to do that, we'll look at in a little while. So the telecommunication service you have recognized over time over the 12 months period. On the other hand, handset, whether it is over time or point in time, because telecommunication service seller performs and customer consumes simultaneously, so that over time. But with regard to handset, whether it is point in time or over time, it is point in time. So which means at the point where the control is passed. So what is the point at which the control is passed? At the inception. That means at day one. On day one, you have recognized the revenue in terms of providing of this handset. Right? Okay. So how do we do the numbers? I'll quickly look at. Right. So this is the answer. I have, because to save time, I put everything. Otherwise, we need time to write and all. Right. So what you do is, so this is actually how do we allocate the transaction price of 12,000, because we decided transaction price is how much? 12,000 rupees. So this is the transaction price. This has to be allocated to each of the performance obligation. To do that, what I do is, first of all, I'm taking the standalone selling prices of each of the performance obligation. So how to take the standalone prices? If you sell handset, what is the price? 3,000. If you sell the telecommunication service only, telecommunication plan without the handset, 800 into 12. 800 into 12. How much? Rupees 9,600. That is the standalone selling price of the telecommunication service, right? Then you add these two together. So once you add these two together, 12,600. 3,000 plus 9,600. Then this is more than the transaction price, right? Because the transaction price is 12,000. Normally, when you sell as a bundle, customer is getting a discount. Here, customer got a discount of how much? 600 rupees, right? Because if you look at these separately, the standalone prices, if you add these two, 12,600. But if you sell this as a bundle, so customer is getting a discount because the total transaction price is 12,000. Then what do is, we need to take the percentage of these two performance obligations standalone selling price. So what do is, we take 3,000 divided by 12,600. 3,000 divided by 12,600. So take the standalone selling price, divide that by the sum of the standalone selling prices, which is how much? 23.8%. Similarly, 9,600 divided by 12,600. 9,600 divided by 12,600. What is the percentage? 76.2%. If you add 23.8%, 76.2%, what you get? 100%. It has to be 100%. Then what we do is, this transaction price, I need to allocate to each of the performance obligation based on the relative percentages. So what do is, I take 12,000, that is my transaction price. I multiplied that by 23.8%. How much? 2,857. Similarly, I take 12,000 multiplied by 76.2%. How much? 9,143. So these are the, so the total transaction price is 12,000. This 12,000 you allocate to each of the performance obligation based on the relative standalone selling prices. So once you allocate, handset 2,857, telecommunication service 9,143. Then we looked at, with regard to handset, you have recognized the revenue, point in time, this one over time. Okay. That means in terms of the handset, point in time means at the inception. Now, if I go one step further, put the double entries, it will be very clear for you. Now tell me, this contract was entered on 1st January 2024. Now we looked at revenue allocated, or the transaction price allocated to handset has to be recognized point in time. Point in time means at inception, on day one. Now tell me, what's the entry that I need to pass? If okay, I'll write here, 1st January 2024, what is the entry that I need to pass? I have recognized the revenue, right? So the credit goes to revenue. Where to debit? Credit entry goes to revenue, no? This one, 2,857. Where to debit? Hurry up, hurry up. We just have only 1 week for the exam. We don't receive cash to debit, because what will happen? Good that I explained this. What will happen? How does you receive cash? You receive cash monthly, 1,000 rupees each. That also you receive at the end of the month normally. You don't receive any cash. So At the inception on day 1, 1st January 2024, you don't receive anything. So because of that, where you need to debit is contract asset. I hope you know the terminology. Contract asset. Debit. How much? 2,857. Credit revenue. 2,857. Right? This is on very first day. Okay. We can't debit receivable as well, right? Can I debit receivable? No, I have to invoice to book a receivable. I can't book a trade receivable without raising an invoice. So the terminology what is used in the standard SLFRS 15 is a contract asset. You have contract liabilities, contract asset. These are contract asset, right? Because you, even though you, what is the meaning of it? Even though you provide this handset on day 1 for free, actually what you are going to do, you are going to charge that amount from the customer. Because if you just provide the telecommunication service, you can charge only 800 per month. Now, as you have provided the handset on the very first day, you can charge 1,000 from the customer. You can charge him more in the future. That's an asset. So that is what this contract asset is. Okay. Right. Let's say then at the end of the month, 31st January 2024. This is the end of the first month. I raised the invoice. How much is the invoice that I raised? 1,000 rupees. That is what I invoiced to the customer. What's the double entry? What's the double entry? What's the double entry that I need to pass? Debit entry. I'll tell the debit entry. Trade receivable debit. How much? 1,000. Where to credit? Revenue credit. How much should I credit revenue? How much should I credit revenue? Now, at the end of the first month, what revenue that I should recognize? Telecommunication service. That means this particular revenue, this amount of the transaction price allocated to the performance obligation. So basically, now telecommunication service revenue has to be recognized over time. Over time means over 12 months. So the amount of revenue that I recognize at the end of the first month is 9,000. If I write down here, 9,143 divided by 12. This is the first out of the 12 months. How much? 762. Can I pass an entry like this? Debit 1,000 and credit revenue 762? No. So what is the difference? 1,000 minus 762. How much? 238. Where it has to be credited? I have to credit somewhere, no? It has to be credited to the contract asset. What is this amount? Balancing figure. But what is the logic? 238. So that is you initially created a contract asset of how much? At day 1 on 1st January 2024, 2,857. This particular, I told you what is this asset? I can charge from the customer more in next 12 months. I can charge the customer more for the next 12 months. So that's an asset. That particular asset has to be amortized or asset value has to be reduced over 12 months. So basically this 238 means what? 238 is actually, so this 238 is actually, if I write down here, the contract asset value 2,857 divided by 12. How much? 238. So the value of the contract asset is getting reduced each month end by 238. Then at the end of the 12 months, the contract asset value would become what? 0. Okay. Then what will happen? You pass this entry, trade receivable debit 1,000, revenue credit 762, contract asset credit 238. Thereafter, let's say customer has made the payment to the company. Let's say customer is making the payment on in 5 months, 5 days time. That means 5th February 2024, you receive the money from the customer. You receive cash from the customer. What's the entry? Simple. Then only you receive cash. Cash debit. How much? 1,000, because the amount what you invoiced is 1,000. TR means trade receivable. No? Trade receivable, credit 1,000. Then trade receivable is taken out from the books. Right? Okay, so examiner can test a question of this nature. I hope you are clear. If not, go through once again and be thorough with this area. Okay, so this, because SLFRS 15 is highly probable this time. That can be tested because telecommunication industry means the complex area is revenue, right? So examiner has given telecommunication industry pre-seen means he definitely, right, if he follow the, if he wants to have a connection between the pre-seen and unseen, he would definitely need to test the revenue, right? But revenue recognition is depending on what examiner says, right? Same question he can give in such a way where there is only one performance obligation. There are no distinct performance obligations. So what I have explained in terms of dialogue. Right, okay. With that, we are done with that particular area. Hope you understood. Did you all understand? That is very important aspect. Did you all understand? Okay, great. Then I told you, right, now if you look at again dialogue, there's a restatement happened in the financial statements in terms of the last year, because these are group numbers for 2024 and these are the group numbers for 2023 restated. What is this restatement is actually, because examiner can test this particular aspect as well. I hope you know this concept, that is principal agent relationship, which means when you are providing or when you are performing a performance obligation, you should understand whether you are acting as the principal or whether you are acting as agent. What do you mean by acting as principal? You perform the performance obligation by your own. You have the control over the particular performance obligation, nobody else. Agent means what? You provide the performance obligation on behalf of someone else. Now, if you are the agent, when you are recognizing the revenue, you have to be careful. What you recognize as your revenue is the commission that you entitle. You can't recognize the entire amount what you collect from the customer as your revenue, because the entire amount what you need to collect from the customer is something that you remit to the pay, that's something that you remit to the principal. So what you can recognize as your revenue is only the commission or the fee that you entitle. Now, by applying this particular, matter to dialogue, what has happened was I told you dialogue has number of subsidiaries, right? What is given in pre-seen is only, limited businesses, limited information. So they have a subsidiary called H1, right? So one of the businesses that this company does is they provide the Microsoft licenses to the customers. Actually, in this arrangement, H1, a subsidiary of Dialog, acts as the agent, because who is the principal? Microsoft. So now, let's say customer, now Sri Lankan customer, buy this particular Microsoft license from Dialog Group. When Dialog sell this particular license to the customer, so what do you say? Dialog is the principal or the agent? I need an answer. What do you say? Now, in this scenario, Dialog is selling Microsoft licenses to the customer. So in that particular arrangement, is that particular arrangement should be accounted as a principal or agent? It has to be the agent, no? Maybe if I don't know the exact percentage, let's say Dialog is getting 20% out of this sale. If the customer pays 100,000 for the license, Dialog is getting 20,000. What has happened up until 2023, Dialog was recognizing the revenue as a principal, right? Which means, let's say in my example, what Dialog has done was the amount that it collects from the customer, 100,000 recognizes as revenue. Then out of that, 80,000 you need to remit to Microsoft. So that being recognized as the cost of sales. Revenue is 100,000, cost of sales 80,000. So the profit is how much? 20,000. That was the approach followed. But in 2024, they have done a restatement. So H1, this particular subsidiary, is classified as agent so that the revenue has to be not 100, revenue has to be 20,000. Only the agency commission that they earn. So when they collect 100,000 rupees from the customer, what is the entity that they need to pass? So let's say you sell the correct approach is you sell a license, Microsoft license, and collect 100,000 cash. Let's assume you get 20% commission. So the double entry has to be cash debit 100,000, right? Your revenue has to be 20,000, 20%. And I'll write the credit entry, the remaining credit entry here. Then the payable to principal, or in this case, let's say payable to Microsoft. How much? 80,000. So this is the correct approach. So your revenue has to be 20,000. Earlier, they were recognizing 100,000 as revenue, 80,000 as cost of sales. So that has been restated. Okay, that has been restated. So where is that? Okay, over here. So this is the note. It's clearly mentioned. This is actually accounting note number 38 in the financial statements of the company for the year ended 31st December 2024. Comparative information relating to revenue and direct cost of the group is changed to reflect the impact of the change in accounting policy of revenue recognition of H1 Private Limited, a subsidiary of the group that act as the agent of Microsoft Corporation in providing Microsoft licenses to the customers. Consequently, revenue is now recognized net of the payment to Microsoft as opposed to the previous policy of recognizing the gross revenue. Okay. So why I did that was actually, let's say when examiner is looking at this particular revenue note, 3 segments, 2 performance obligation, there's a restatement note. Okay, he look at this note, and if the question is asked from the restatement, now you know that aspect as well. We cover that aspect as well. That is about the principal and agent relationship. Right. Done. Okay, so I discussed a lot of things in terms of SLFRS 15. It's really important, right? So really important. It's really important. So pay full attention to what the area that we discussed, right? Okay, then moving on. So look at this now. I mentioned the way that I'm doing. So look, I'm looking at a particular phrase of the pre-scene and I explain what is the relevant area. Now let's see whether you can explain or you can tell me what is the area in which this particular para, what can be the standard that is going to be tested out of this para. Can you look at it and tell me? Yeah, number of areas actually. Main risks arising from STL's financial asset, financial liabilities are foreign exchange, interest rate, market, liquidity, access to finance sources, and credit risk. So they explained about number of risks, right? Foreign exchange, interest rate, market risk, liquid risk, access to finance, credit risk. STL is exposed to foreign exchange fluctuations from its operation with foreign mobile operators and suppliers. So it is because there are a lot of services taken from the foreign operators, mobile operators and the suppliers. So which means you are getting the invoices in foreign currency, dollars, right? So you are exposed to the fluctuation of the exchange rate, sorry. These relate to STL's these relate to STL's translation of the foreign currency earnings, payments, and carrying value of STL's overseas operations, right? So obviously what will happen is once you have dollar denominated payments as well as dollar denominated earnings, and also you might have dollar denominated assets and the liabilities like trade receivable, trade payable. So the company is exposed to the foreign exchange risk. Then substantial amount of the purchases and the liabilities of foreign operation are denominated in foreign currencies as opposed to the local currency of those operations. This is what I mentioned, a lot of foreign services are taken. So because of that, your cost of sales, right? As well as at the year end, if you have payable balances, you are exposed to the foreign exchange risk. So now the areas what is tested in this particular para is, more specifically, I can say, first of all, LKS 21, right? LKS 21, the effects of the exchange, the effects of the changes in foreign exchange rates. So what happens is, we know, first of all, when you recognize the P&L items, now let's say there's a foreign currency service or foreign service that the company enjoy. So you have to use if the invoice is denominated by the foreign supplier in foreign currency, let's say in dollars, you have to convert that into rupees and record. So what is the rate that you use? What the standard says is, use the exchange rate at the rate of the transaction, spot rate. But this would be practically not possible if you have a lot of transactions. Then what you can do, you can use the average rate as an approximation, provided spot rates are not fluctuating significantly, right? So it can be the weekly average, it can be the monthly average. That is in terms of the transactions in the profit and loss statement. In addition to that, there's a balance sheet impact as well. Because why? If these invoices are unsettled at the year end, so you'll be having trade payable balance on the balance sheet. So these trade payable balances, what you have is a dollar denominated figures. Then you have to decide whether I should convert this by using the closing rate at the year end, or should I keep that at the historical rate? Okay. In addition to that, this particular pre-scene also includes another area where the company has some foreign or USD denominated borrowings. Company has what? USD denominated borrowings. So what it says, in addition to the regular bank borrowings, STL has recently entered into an agreement with the International Financial Corporation and has access to a loan facility of $100 million. This funding will be used to expand and enhance the broadband connectivity throughout the country. Okay. So which means it's a kind of a foreign currency loan, right? Given by IFC. So yet again, it's a huge value, right? Liability. So the company is what? Exposed to the foreign exchange risk, right? So now what will happen is, what the standard says is, now you have a question, you have a lot of foreign currency liabilities at the reporting date in the statement of financial position. So the question is, should we convert these liabilities by using the closing rate or not, or else should we keep that at historical rate? It depends on the type of the item, whether it is a monetary item or non-monetary item. So if it is a monetary item, now to both examples what I discussed about, trade payable as well as the loan payable, are what? Monetary items. Monetary means you know exactly the amount or the number of units of currency that you need to pay. How many number of dollars that you know. So those are monetary items. What you do is, monetary items you need to convert by using the closing rate. So which means there are unrealized exchange gains and the losses. So the company is exposed to the foreign currency risk. But if the items are non-monetary, let's say if it is a non-monetary item, like property, plant and equipment, non-monetary item, so which are kept at historical cost, are we doing the retranslation by using the closing rate? No, you keep that at the historical rate. But if it is a non-monetary item, but if it is revalued, let's say property, plant and equipment item, non-monetary item, if it is revalued, you have to use the exchange rate at the date of the last revaluation. So what is applicable for this particular scenario is actually the monetary item, both loan, $100 million USD loan, as well as the foreign currency trade receivable, foreign currency trade payable are what? Monetary items. Those are to be converted by using the closing rate. There are exchange rate risks. In addition to that, this entire thing, this para, also highlights one more important area. What is that? Financial risks, right? What is the applicable standard? Some people have mentioned SLFRS 9. Is it SLFRS 9? Disclosures. So this is actually more relevant to SLFRS 7. So what is SLFRS 7? Financial Instrument Disclosure Standard. Okay. So in this particular standard, there are two main disclosures that you need to make. Two main disclosures. What are these two disclosures? One is significance of the financial instruments to the financial performance and the financial position. Second major disclosure is nature of the financial risk that the company is facing, right? Nature and the financial effect of the financial risk that the company is facing. Now, basically in the standard, it talks about number of types of financial risks. Actually, all these types of financial risks are addressed in that particular para. So because of that, because this particular area, disclosures have not been tested regularly, but time to time there are questions from the financial risk disclosures, right? So discusses about the credit risk. What is the credit risk? That means what if counterparty defaults? Now, a company like Dialog, so you have many customers. I can remember in the pre-scene, it was mentioned that company has about 15 million customers. So there are good customers, there are bad customers, there are decent people and there are not, right? So what will happen is there's always a risk of default. So that is what credit risk. Then what the company does is, up to an extent, company covers this risk by taking a deposit, initial deposit. Okay, right? But still there is a exposure over and above that particular deposit. Then what about market risk? Market risk means either the fair value or the cash flows of the particular financial asset or the liability is fluctuating. Now the market risk has different categories. So there are three subcategories under the market risk. Actually, currency risk is coming under that. Now, when you have foreign currency assets and the liabilities, what will happen? Once the exchange rate changes, the assets and the liability values are getting changed. That is the currency risk. The interest rate risk is mainly associated with the floating rate borrowings. Once the market interest rates are getting changed, if you have taken a loan at a floating rate, AWPLR plus 1%. So once the AWPLR is getting changed, so your cash flows are getting changed. Then other price risk means, let's say if you invest in shares of a, like, let's say you have a portfolio of shares, which you keep as an investment. So once the share market prices are fluctuating, what will happen? Asset values are getting fluctuated in your balance sheet. So these are market risks. Then liquid risk. What do you mean by liquid risk? That is, you can't settle your obligations on due date, right? So because of the cash flow difficulties, company can't pay on time. Then what will happen? It's not a good reputation to the company, bad image. So what I believe is, based on the information given, examiner can test and question in terms of these risk items. So what we do is, actually in the financial statements, there are qualitative information as well as there are quantitative information presented in terms of these risks. If I take few examples, let's say credit risk. What are things that you present in the financial statements? You provide a debtor's age analysis. Then you provide the net exposure. What do you mean by net exposure? What is the gross value of the trade receivable? Have we taken any deposits? Have we taken any bank guarantees? If so, you deduct that from the gross carrying value and say that this is the net exposure. Then under market risk, under currency risk, you do the sensitivity analysis. If the exchange rate changes by 1%, what is the impact on profit? Similarly, once the interest rate changes by 1%, what is the impact on profit? Then under the liquid risk, you present maturity analysis of your liabilities. So how much of liabilities to be settled? 0 to 3 months, 3 to 12 months, 1 year to 5 years, after 5 years. So a lot of things are disclosed under the disclosed in the financial instruments. So be aware of what you have learned in your, theory studies. As well as there are few questions tested in the past papers. Right. Okay, hope you understood. I'm going through, right, because there are areas to cover. Still, we are in the, discussing the accounting standards. So we need to look at consolidation. That is one of the most important area, as well as bit of ratio analysis as well. But I took some time to explain especially about the revenue recognition, as it is important. Okay, so the session will drag maybe for 3 hours or little more. I hope you are okay with that. Okay, would that be all right? Because you are sitting for, one of the important examination. Because I can rush, but the matter is if I rush, you might not be able to understand. Okay, so that's why I'm taking a bit of a time. Hope you're okay with that. I'll give a little break, right, at the, middle. So once we complete the accounting stance, we'll take a break. So thereafter, we'll go to the consolidation, right? Okay, moving on. Good, thank you for the positive response. Then moving on, so treat that and tell me what is the area this can be tested. This has not been tested for a very long period of time, this area. I'll tell you what it is. So can you guess? What is the area in which this particular para is relevant to? Where it says SLT uses various financial instruments to hedge its foreign exchange risk, such as forward contracts, currency options, currency swaps, and other derivatives. Hedging method chosen by STL depends on markets and currencies involved and the objective of the hedge. So this is about derivatives, financial instruments, more specifically the area is derivatives. So the company is using derivative products to minimize the foreign currency risk, because I told you companies facing an enormous amount of foreign exchange risk. So to minimize that risk, companies using what? Derivatives. So what are the derivative products? Forward contracts, currency options, currency swaps, and some other derivatives. So now in terms of the financial reporting paper, what you need to understand in terms of the derivatives is just understand it is a derivative. You don't need to look at what are the features of the swaps, what are the features of the options that you look at in financial management. Here, if it is a derivative, the accounting treatment is same. It can be a forward contract, it can be an option, it can be a swap. If it is a derivative, accounting treatment is same. So in financial reporting, what you need to understand is, okay, whether it's a derivative or not. Then what is the accounting treatment? Now, why do I say that? So the area is SLFRS 9, financial instruments, more specifically derivatives. So there are 3 important characteristics of a derivative. What are 3 important characteristics? Always the value of the derivative is depending on an underlying. Let's say today, let's assume exchange rate today is 300 rupees per dollar. So what is the rate? $1 is equal to rupees 300. This is spot. As at today. You enter into a forward to buy. Now you know that in 6 months time, I need to make a payment. I need to make a dollar payment. Let's say $100,000 to be paid. So I enter into a forward where the forward rate is 303. This is the 6 months forward. Let's say you enter into this contract today, forward contract today, 6 months forward to buy dollars at 303 rupees. After you enter into the contract, the value of this contract, value of this derivative is depending on what? Movement in the exchange rate. Which way it goes. Whether it would go to 305 or whether it would go to 297 or whether it would stay at 300. So the value of the derivative is depending on the underlying. In this particular derivative, what is the underlying? Exchange rate. So if it is the currency related derivatives, it can be a forward contract, it can be a currency option, it can be a currency swap, it can be a currency future. The underlying variable is what? Exchange rate. So the value of the derivative is depending on the underlying. So it can be a derivative asset or it can be a derivative liability. Whether it's a derivative asset or a derivative liability is depending on the movement of the underlying. Underlying in this particular scenario is the exchange rate. Exchange rate against the dollar to rupee. I'm not going to explain the rest of it. Then the second feature is little or no investment. Now, the value of this forward contract is huge. But at the beginning, to enter into this contract, no investment or very insignificant investment. Okay. But the contract value can be huge. It can be $1 million. It can be $10 million. According to the value of the contract, the investment is zero or very little. Third thing is it's settled in future date in 6 months' time. So if you have these three characteristics, it's a derivative. If it is a derivative, what do you need to do? What is the accounting treatment in the standard? SLFRS 9 says that derivatives are to be measured at fair value. It can be a derivative asset, it can be a derivative liability. It has to be measured at fair value, and the fair value changes are to be taken to the profit and loss statement. Are we clear? I have not yet discussed about the hedge accounting. I am talking only about the derivative yet. So derivatives are to be measured at fair value, and the fair value changes are to be taken to the P&L, which means FVTPL. That's clear now? Then the question is whether this company would apply the hedge accounting. Hedge accounting is not tested for very long period of time, right? So in the new syllabus, there were no questions from 2020 onwards. So there were no questions. In the previous syllabus, there was a question somewhere in 2017 or 18, there was a question, right? Since then, I can't remember this area has been tested in the exam, but it doesn't mean that examiner can't test. So because of that, as you know, this currency risk and the derivatives have been discussed. So have a look on this area, hedge accounting. Now, this particular company has entered into the derivatives. Entered into the derivative mean, tell me, is that compulsory for the company to follow the hedge accounting? Now, they have a foreign currency risk. They have entered into derivatives like this forward exchange contract. My question to you is that compulsory for them to follow the hedge accounting? Remember, hedge accounting is optional. It's not mandatory. Even company has entered into derivatives to minimize the foreign currency risk. Company can decide, I'm not going to follow the hedge accounting. But always better to follow hedge accounting, because hedge accounting avoids the volatilities in your profits. Avoid the volatilities of the financial performance of the company. But for you to apply the hedge accounting, just having the derivatives are not enough. So these three criteria has to be satisfied. So it's a must to satisfy these three criteria. What are three criteria? Number one, there should be a designated hedge item and hedge instrument. There should be a hedge item and the hedge item can be a recognized asset or a liability. It can be a firmed commitment. It can be a highly probable forecasted transaction. So in your syllabus, there are three hedge items. So the hedge item has to be either recognized asset or liability, like inventory item, highly probable forecasted transaction, or a firm commitment. Then hedge instrument is so hedge item creates the risk. Hedge item creates the fair value or the cash flow risk. Hedge instrument is the derivative that you have entered into offset the risk. Right? Hedge instrument is the derivative that you have entered into to offset the risk. If the hedge item creates a loss, hedge instrument creates a gain, offset. If hedge item creates a gain, hedge instrument creates a loss, again offset. Hedging is offsetting. Hedging is not done to make money, or hedging is not done to make profits. That is offsetting. So for you to apply the hedge accounting, there should be a there should be eligible hedge instrument and eligible hedge item. You have to identify what these are. Not only that, there should be a formal documentation about the hedge instrument and the hedge item at the inception of the hedging relationship. So there should be a document. Now, let's say if you are an auditor, where you are auditing the financial statements of a company, what you need to do is, now let's say a company has applied the hedge accounting. What you should ask first question, okay, what is your hedge item? The client is saying that, okay, this is my hedge. If he's knowledgeable, otherwise he's, fully confused what you're asking for. But let's say, okay, he's a knowledgeable way. He say that, okay, this is my hedge item. Then you ask, okay, what is your hedge instrument? He say that this is the forward contract, is my hedge instrument. Okay, first criteria is satisfied. First, second question that you need to ask. Okay, show me the document. Because why? There should be a documentation, formal documentation, identifying the hedge item and the hedge instrument. To explain, this is the item which create this risk. We have entered into forward contracts to minimize. There should be a formal what? Documentation happen in terms of that. Okay, so thereafter, the third thing is what? It should meet all the effectiveness requirement. Now, under these all effectiveness requirement, there are 3 sub criteria. I'm not going to explain, but have a look on your tutors or the whatever the videos that you're following. Have a look. There are 3 effectiveness requirements are to be met, right? So all these 3 sub criteria has to be satisfied. Then only you say that all effectiveness requirements are met. So upon satisfaction of all these 3 conditions only, you need to apply the hedge accounting. Clear? Right? Then the next thing is, what is the hedge accounting model that you need to follow? In your syllabus, there are 2 main hedge accounting models that you need to be aware. One is fair value hedge accounting model. The other one is what? Cash flow hedge accounting model. So it's very descriptive. I'm not going to discuss at this moment about, okay, what is fair value hedge accounting model and how to apply, and also the cash flow hedge accounting model and how to apply. So I know that you have learned that. So ensure that you go through these areas, because it has, as I mentioned, it has not been tested for a very, very long period of time. Under new syllabus, it has not been tested. So maybe examiner wants to test before the syllabus revision. Okay, right. Is that clear? Okay. Right, this is straightforward, right? So the area in which this is tested is straightforward. Corporate tax is provided at amounts expected to be paid or recovered using the tax rates and the laws that have been enacted or substantially enacted by the reporting date. Taxes are recognized based on the tax rates enacted or substantially enacted at the reporting date. Deferred tax is provided in full on temporary differences that exist at the reporting date, and the results in obligation to pay for more taxes or right to pay less tax in the future. So basically that is the whole concept of deferred taxes, right? If you need to pay more taxes in the future, you have recognized a deferred tax liability. If you have to pay less taxes in the future, you have recognized a deferred tax asset. Deferred tax is measured at the rate expected to be applied in the periods in which temporary differences are expected to reverse based on the tax rates and the laws that are enacted or substantially enacted at the reporting date. When you are recognizing the deferred tax assets and the liabilities, we learned deferred tax assets and the liabilities are based on the temporary differences. So what is that? LKS 12, income taxes. So what is the temporary difference? In very brief, right? Again, very detailed topic, technical topic, need to be aware. So temporary difference means what? Carrying value of the, if I take an example of an asset, property, plant and equipment item, what is the carrying value? Book value. And what is the tax base? Tax base is what? Cost minus the capital allowances. Carrying value means what? Cost minus the depreciation. So we know depreciation rate and the capital allowances rate are different. So because of that, your carrying value and the tax base of the particular asset item, PP&E item in my example is different. So you take the difference, that difference is the temporary difference. Then you need to identify whether that temporary difference is a taxable temporary difference or a deductible temporary difference. This is what it is explained in the para over here. Because of that temporary difference, if I need to pay more taxes, currently I am paying less taxes, but in future I have to pay more taxes. In deferred taxes, what you are looking at is the future. If I need to pay more taxes in the future, that's a taxable temporary difference leading to a deferred tax liabilities. On the other hand, because of that temporary difference, in future, I need to pay less taxes, like tax loss carried forward. If I have to pay less taxes in the future, that's a deductible temporary difference leading to a deferred tax assets. So what you do is to calculate the value of the deferred tax liability or the deferred tax asset, you get the value of the temporary difference. That can be a taxable temporary difference or that can be a deductible temporary difference. Let's say temporary difference is 100,000. So that 100,000 you multiply it by the tax rate applicable. Let's assume tax rate is 30%, right? Where the temporary difference is 100,000. When you take the tax rate, it has to be the tax rate enacted or substantially enacted at the reporting date. And that has to be the tax rate that will be there at the time where this temporary difference is getting reversed in the future. So how do we calculate the deferred tax liability or the deferred tax asset? You take the temporary difference and multiply it by the tax rate. So that is how much? 100,000 into 30%. It is how much? 30,000 in this example. Then most of the times, now let's say this is a taxable temporary difference as an example. So 100,000 into 30% deferred tax liability is 30,000 rupees. Then when you recognize a deferred tax liability, you have to pass a double entry. No? So what's the double entry? Deferred tax liability credit 30,000. Where to debit? Most of the times you debit to the P&L. But there are certain situations you debit the other entry. It can be debit or credit depending on whether it is taxable or deductible. So the other entry goes to OCI or equity. Example, let's say if the deferred tax liability is recognized based on a revaluation gain of a PP&E item, then the revaluation gain is recognized in OCI. Through that it goes to the equity. The relevant deferred tax impact on that revaluation also to be taken to the OCI and equity. But most of the times it is taken to the P&L. And also we know there are restrictions in terms of the deferred tax asset recognition, because if it's a deferred tax liability, no question, recognized in full. Prudence concept. If it's a liability, recognized in full. If it's an asset, question mark. What is the question mark? Whether I can recover the value of the deferred tax asset. Okay. So if we can recover, recognize. Otherwise, limit it. Don't recognize. Okay. So just gave a brief on what is important. So as this particular para was specifically given, there's a probability of testing. As I said, I'm telling you all the important areas, right? All the possible areas. All these things are not going to be tested for sure, right? But we don't know what it is, right? But the time I spent for the important aspects like revenue, I spent a lot of time. So that means that is important, right? Right, moving on. Okay, tell me. Read this and say that whether you can identify what is the area where this can be, where examiner can test by looking at this information, this bit of information. Right, case 23, 24. Okay, let's read it. STL's policy is to borrow centrally using mixture of long-term and short-term capital market sources and borrowing facilities to meet anticipated future funding requirements. These borrowing and cash generated from operations are loaned internally or contributed as equity to create equity to certain subsidiaries. Okay, what they do is, if I quickly go to the group structure, right? So there's the group structure. No? So what they do is they look at funding centrally. That means STL look at either long-term or short-term funding sources. Then that the money that they have borrowed, they either invest by themselves, they do investment by themselves as well, or else they give it to the subsidiaries. When they give it to the subsidiaries, it can be either in way of equity, it can be, now this is a parent company, no? You can invest in equity. This particular subsidiary can make a rights issue. That means parent has to invest. Or else it can also be given as an intercompany loan. So the funds borrowed by STL is given to the subsidiaries to undertake the projects as equity capital, either inject as equity or else what, intercompany loans. So as you correctly identified, yes, there can be a question from borrowing cost. I will highlight that borrowing cost standard and the important areas once I go through the financial statements, right? But what I wanted to highlight is, because this is being a group, obviously, related party transactions. These are related party transactions. When parent is giving a loan to the subsidiary, it's a related party transaction, right? So there are disclosures that you need to make in terms of what? LKS 24, right? In terms of LKS 24 related party disclosures. So when you go to the examination, this is the diagram that you need to have in your mind. So this explains all the related party relationships that you need to keep in your mind. Now, if you look at, if I apply this to STL, our reporting entity, let's say STL, this is STL. Then STL has a parent. So different percentages here. So in our example, it was how much? 80%. So we are identifying related parties to STL. So the parent company is a related party. So the Singapore, Telecom Singapore. So that is a related party. What is given in light blue are the related parties. What is given in red are not the related parties. Then STL has subsidiaries, two subsidiaries, PPL and VTV. So those are what? Parent is a related party, subsidiary is a related party. Similarly, STL has any associates? In this question, there are no associates. Or else if STL has entered into a joint venture with another venturer, another investor. Let's say STL has 50% holding of this venture. Other investor also has 50%. So the STL together with the other investor has the joint control over this joint venture. So in that case, this joint venture is a related party, but the other venture, other investor is not related party to STL. Right? Because even though there's no joint venture in the pre-scene, examiner can give you a joint venture in the unseen, which you look at the areas, possible areas in terms of the consolidation, examiner can give you a scenario of a joint venture in the unseen, right? Then not only that, if STL has an investor who has significant influence, normally having a shareholding of 20% to 50%, we believe that investor has a significant influence over the investee. Now, in this case, let's say there's an investor who holds 35% holding of STL. So that investor, so the investor would become a related party to STL because STL would become an associate of that investor. So that's a related party. Not only that, the parent company of STL, now this Telecom Singapore, that particular parent company can have subsidiaries. That particular parent company can have associates. That particular parent company can have joint ventures. Those subsidiaries, associate, or the joint ventures of the parent company are what? Related parties to STL. Right? Then when it comes to the people, individual, key management personnel of SLT and close family members of those key management personnel. Key management personnel means what's the definition in the standard? Anyone who has the authority of planning, directing, and controlling activities of the organization are classified as KMP. Now, board of directors are definitely KMPs. Then not only that, senior management like CEO, CFO are what? Key management personnel of the entity. So the key management personnel of the entity, that means SLT, as well as close family members of these KMPs are what? Related parties. Not only that, key management personnel of the entity's parent, that means key management personnel of Telecom Singapore, right? Board of directors of Telecom Singapore and senior management of Telecom Singapore. And their close family members are what? Related parties to STL. So your KMP and close family members. Your parents' KMP and close family members are related parties to you. Not only that, if any of these people, it can be your KMP or one of the close family member, or it can be parents KMP or one of the close family member of the parents KMP, might have any subsidiaries, associate, joint ventures, those subsidiary, associate, or the joint venture would become what? Related part to you. So it's white. Okay. So again, it has not been tested for a while, the area. So if examiner test this particular area, this is what you need to have in your mind. So you have to identify who are the related parties and what are the disclosures that you need to make. Amount of the transaction, what is the transaction, amount of the transaction, and what is the outstanding value. You have to make the necessary disclosures as per the standard. Right. Moving on. Right, moving on. Then in this particular pre-scene, you have been given the financial statements. Right, you have been given the financial statements. Now, first of all, you have been given the statement of financial position of STL as at 31st December 2024, as well as statement of profit or loss and OCI for the year ended 31st December 2024 are given. Now, when you look at, I'm not going to go through from the beginning, so because you should have gone through by now. So I'll tell you what are the important aspects in addition to the areas what I have discussed already in terms of the standards, right? This is in the telecommunication industry. So always in the telecommunication companies, PP&E are what? Significant. Now let's say towers, telecommunication towers, a huge investment is classified as PP&E. Okay, they have a lot of towers across the country. Then relate to this, earlier I told you company borrowed funds, short-term loans, long-term loans. And if you look at in the next slide, you have been given certain ratios. Debt ratio is what? 71.99. That means heavily geared. So what examiner can combine a question of PP&E with what? Examiner can easily what? Combine a question of PP&E with what? LKS 23, borrowing cost. Okay. So one area is PP&E. You can say that. So this particular PP&E is funded by using these borrowing sources. And there the question is, okay, are we incurring borrowing cost in terms of a qualifying asset? What do you mean by a qualifying asset? As per the standard LKS 23, asset which necessarily takes substantial period of time to get ready for the intended use. Now, in terms of the towers, it takes sometimes years to, construct. Okay, a lot of work to be done. So it's a what? Qualifying asset. So whatever the borrowing cost that you incur on the loan that you use to fund that particular tower, what you need to do? You have to capitalize. You must capitalize. If you expense, that's wrong. Right? So I'll come back. So these are the standard relevant LKS 16 property, plant and equipment and LKS 23 borrowing cost. Okay, by looking at the financial statements, in terms of the borrowing cost, I explain what is a qualifying asset. Asset that necessarily takes a substantial period of time to get ready for the intended use or sale. So then he can, accompany a question of capitalization timeline. When you should start capitalizing the borrowing cost, when you should stop, right? So to start the capitalization, 3 conditions are to be met, right? Expenditure has to be started. That means whatever the material cost, labor cost you need to incur, borrowing cost has to be incurred. You have to pay interest. And activities are in progress. Construction work is started, going on. So then only upon satisfaction of these 3 conditions only, you have to start capitalizing the borrowing cost. Up until satisfying all these 3, you can't capitalize the borrowing cost. You have to expense. Then you have to stop capitalizing it once the asset is ready for the intended use. Then there can be situations where you need to suspend capitalizing the borrowing cost. Let's say there's a labor strike. You have not paid on time. For months, laborers are not working. But you have to pay interest to the bank. Can you capitalize that borrowing cost? No, because you can't capitalize your inefficiencies. So then you have to suspend the capitalization. But there are instances, even though there's no activity in progress, but still you can continue to capitalize. Okay, if I take one example, let's say there's a temporary delay due to an external event. Let's say there's a flood. For a week, you can't do the construction activity. That's a what? Temporary delay due to an external event. So that you can continue to capitalize. Right? Likewise, there are other things. You should be aware about this particular timeline in terms of the borrowing cost capitalization. Okay? Right. Again, if you can't remember the things what I discussed, what you do? Go back and look at the videos, look at the tunes, get your knowledge revised. Okay. Right. Going back to the financial statements. Then the other thing what I want to highlight here is right of use asset. And in terms of the liabilities, you have lease liabilities under non-current as well as current. Okay, so SLFRS 16, it has not been tested last time. So it's a popular area of the examiner, right? SLFRS 15 and 16 as well as 9 are popular, three popular areas. So 16 was not, SLFRS 16 was not tested last time. You know, if it's a lease, in perspective of the lessee, you have recognized the lease liability and the right of use the asset. Then the right of use the asset has to be amortized over the lease term. Then the lease liability, you need to account at amortized cost. There are other concepts like, you know, modification of leases, sale and lease back, you know, broad area. Finally, I want to highlight one other aspect which I told you at the beginning. Even though there are not much of impairment indicators are given in this particular pre-scene, if you look at the P&L, there's an impairment loss. That's why I mentioned about the impairment at the very beginning, right? There can be an impairment loss in terms of if you don't invest in technology, there can be technological obsolescence. Through that, assets can be impaired. In addition to that, it was not mentioned for which this impairment loss is related to. This can be related to a trade receivable balance as well, because when it comes to telecommunication company, you have a lot of customers. There are good as well as bad customers. Some people pay, some people don't pay on time. So then you have to apply the expected credit loss model, right? You have now, you know, there are, in terms of the expected credit loss model, there are stages: stage 1, stage 2, stage 3, performing, underperforming, non-performing. Then how to calculate the expected credit loss? 12 months, lifetime. Then how to calculate the interest income on gross carrying value, net carrying value. So this is the 3-stage process, but I believe that most of the debtors or the customers, debtors means customers, would settle within the 12 months period, right? In terms of a company like Dialog, most of the customers. So if you have, you know, debtors without a significant financing component, in simple language, if debtors are settling within 12 months period, you don't need to go through this stage 1, stage 2 and stage 3 model. So what you can do is you need to apply actually the simplified model. So the simplified model means you just apply the lifetime expected credit loss model because there is no significant financing component. See, there's no significant financing component means settlements are taken place within a year. So if the settlements are taken place within a year, no significant financing component. So which means without applying the 3 stages, you can directly go ahead with the simplified model, what is explained in the standard. Just apply the lifetime expected credit losses because lifetime is less than a year. Okay, so my point is, yet again, I do not have time to explain what is stage 1, stage 2 and stage 3, right? But if I, you know, quickly tell you by looking at the picture, you can understand. This is the type of the customer. Let's say you have given a loan. Let's assume bank has given a loan, right? So here customer is happy, which means he is paying on time, no issues, right? Your credit risk has not increased from the initial inception, right? So from the date where you have given the loan to the reporting date, your credit risk has not increased. So it's a performing loan, performing customer. So what you do is you just need to apply the 12 months expected credit loss model. And your finance income, interest income has to be recognized based on the gross carrying value. What is the gross carrying value? Now, if I take an example, let's say gross carrying value is the value of the loan, value of the trade receivable or whatever. Let's say gross carrying value of a particular financial asset is 1,000. Then from this, you deduct the loss allowance. You deduct the loss allowance. Let's assume loss allowance is 50. Then what is the net carrying value? Net carrying value 950. Now, when the particular loan or the trade receivable or whatever is in the stage 1, you recognize the finance income by applying the effective interest rate to the gross carrying value. That means 1,000 into the effective interest rate. You take the finance income. Stage 2 means what? Underperforming. Customer has some problems. He is under difficulties, right? Normally, if the particular payment is outstanding for more than 30 days, we say that it is underperforming, right? So in that case, your credit risk has significantly increased from the inception of from the initial recognition of the financial asset to the date, the lender's credit risk has significantly increased. So that you need to follow what? Not 12 months expected credit losses. You have to recognize more credit losses by using the lifetime expected credit loss model. But still, you recognize the finance income based on the what? Gross carrying value. Stage 3 means customer is bankrupt. He doesn't have cash to pay. So the non-performing loan. There's objective evidence of impairment at the reporting date. So you have to apply the lifetime expected credit loss model, as well as you have recognized the finance income or the interest income on the net carrying value. Net carrying value into the effective interest rate. Okay, but this particular model is applied by the companies where your financial asset lifetime is more than 1 year. There's a significant financing component. Banks are using this. But for a company like, in this particular case, SLT or even Dialog, so the example that we are using, most of the customers settle the dues within 1 year. So no significant financing component, so that you can apply the simplified model of lifetime expected credit loss model for the entire trade receivable portfolio that the company has, right? Okay, going back, we are looking at the financial statements. So I explained about SLFRS 16 leases, and I have explained about SLFRS 9 financial instruments, right? So by looking at the set of financial statements of this company, STL, this is what I can figure it out other than the areas what I have discussed in terms of the accounting standards, right? Any other thing that you want to highlight? Any other thing that you want to highlight? No, right. Okay, then you have been given, certain figures in terms of the revenue, GP, operating profit, net profit, EPS, dividend per share, then ROC, return on capital employed, debt ratio over the last, so some years. So you have been given the information, right? There even I highlighted debt ratio is quite high, so that there can be significant amount of finance cost incurred. So the applicability in terms of the financial reporting is there can be qualifying asset like towers, where the borrowing cost that you incur, you need to capitalize. Then you have been given the statement of financial position of BCC. So this is a kind of a target company. This is important in the consolidation. So you have been given the statement of financial position of possible or probable target company, BCC, which we will discuss in consolidation area. Right, so this I have discussed. I have explained about the applicability of LKS 23, borrowing cost standard. I have explained about the applicability of expected credit loss model in SLFRS 9. And I just wanted to highlight this aspect as well, right? That is, in your pre-scene, you have been given the segmental revenue and gross profit. So that is actually the 4 different businesses that we were discussing about. So the mobile telecommunication, which has the highest revenue and GP, then the fixed telephone or fixed telephony, right? So that is the next big business. After that, broadband services and the television. So these are the 4 segments that they have identified in the financial statements where you have been given the revenue and the gross profit. What I wanted to tell you is, now even if you look at this particular application of SLFRS 8 operating segment, so this is the management approach of segmentation. So when now SLFRS 8 is purely a disclosure standard, you have to disclose information about the reportable segments. You have to disclose the information about the reportable segment. What information? Revenue, profit or loss, assets, liabilities of each of these segments. Now, the disclosure of information is the final step. Now, to go there, you have to follow certain steps. What are the steps? First of all, you have to identify CODM, Chief Operating Decision Maker. So Chief Operating Decision Maker is the one who makes the decision about the performance assessment and the resource allocation. I looked at Dialog. Here, they have identified their board of directors, entire board of directors as the CODM, right? It can be a person, it can be a committee, right? Now, in some companies, it is the group CEO, but in Dialog, they have identified board of directors as CODM. Then you need to identify operating segments, right? So to identify as an operating segment, there should be 3 conditions to be met, right? So if I tell you able to earn revenue, results are reviewed by CODM, and discrete financial information is available. Upon satisfaction of these 3 conditions, you identify that as a what? Operating segment. Then you need to aggregate these operating segments. You can't present, let's say, 10 segments. So you have to aggregate based on the what? Similar economic characteristics, similar risk aspects. Then there are certain criteria given in the standard. It has to be a similar product. It has to be a similar customer. It has to be a similar regulatory environment. It has to be a similar distribution. So likewise, you have been given certain criteria. Based on those criteria, you aggregate the identified operating segments. Then, based on the quantitative thresholds, there are 3 quantitative thresholds: revenue, profit or loss, assets, and also there's something called consolidation revenue test. So need to do certain number crunching and identify what are the reportable segments. So these are based on the numbers. So basically, whether it is big enough to report separately in the financial statements. Reportable segments, then finally, you disclose the information about the reportable segments. So I don't have the time to explain each and every step in detail, but I have given a summary. So based on the information available, examiner can look at that aspect as it. This is the note included again in the annual report of Dialog. What it says: operating segments are reported in manner consistent with the internal reporting provided to CODM, Chief Operating Decision Maker. So your segmental information, what you present in the financial statement, should be in line with the internal information that you give it to the CODM. Okay, so this is actually operating segments mean you provide information to the users of the financial statements in the eyes of management. How management look at the business. So same information you have to give to the users. Chief Operating Decision Maker, who is responsible for allocating resources and assessing performance of the operating segments, has been identified as board of directors that make the strategic decision. So likewise, the rest actually you can go through. Now, at last, if you look at 31st December 2024, group organized into 3 main business segments. Now, in our SLT, here they have identified 4 segments, but if you look at Dialog, what they have done was they have combined fixed telecommunication and the broadband. But here in SLT, fixed telephone is separately, broadband services separately. There's a slight difference. Let's say I said that. So examiner doesn't mention us, okay, he's questioning or looking at Dialog. We assume it is dialogue. Right. So the mobile operation, fixed telephony and broadband operation, and the television operation. So these are the segments, reportable segments identified by dialogue, and they made their disclosures about the revenue, assets, liabilities, profit based on this particular classification. Okay. Right. So actually we have completed the areas relevant to accounting. There are a few questions about financial statements, especially there's inventory balance, small value, right? So whether they will test on the COSO NRV. If examiner can has a liberal test, but I don't believe that it's not material in terms of this telecommunication industry for him to test that concept. But no, yes, all liberals do test anything. Right. So what we can do is now we have discussed all the relevant areas. There's nothing else other than this, right? So even minute areas I have discussed, right, in terms of the accounting standards. So we have done that part. What we can do is we'll take 5 minutes break, right? We'll take 5 minutes break, and thereafter or else we'll take 10 minutes break. Doesn't matter, no, 5 or 10. So we'll take 10 minutes break, fresh up your minds, because consolidation is the most important aspect. Because the question, unseen question, most of the marks in terms of financial reporting is allocated for consolidation. So because of that, I need you to be, focus when I'm discussing this, because because in this particular pre-scene, it's not exactly clear what examiner is going to test, even though it seems to be clear. Okay, so there can be different scenarios, or because of that, I have included a number of scenarios where you need to be, fresh in your mind to look at that. So we'll take a 10 minutes break, and thereafter we'll discuss this area, right? Okay. Okay, let's start the areas relevant with consolidation. Okay. Now we have done the introduction, then the accounting standards, two more areas, consolidation and the analysis and the interpretations. Right. So this is the group structure which you already know, right? Our main companies, Singtel, Lanka PLC, STL, right? STL. So the STL is 80% held by Singapore Telecom PLC. Okay, 80% of the share capital of STL is held by Singapore Telecom PLC, which is the parent company of STL. Then STL acquired 90% of Payphone Private Limited, PPL, and STL also acquired 100% shareholding of Vista TV Private Limited, VTV. This is the structure, same diagram what is given in the pre-scene. So now actually mainly the questions are tested from the point of view of STL, right? So because of that, by taking that into account, so this is the pre-scene information what is relevant to us, right? To look at or to predict what's going to be tested in the examination. So in summary, STL holds 90% of PPL and STL holds 100% of VTV. So this is the current group structure. Okay. So we are now to predict what is going to be tested in the examination. So for that, so there are certain direct information as well as there are some indirect information given in the exam. Now, if you look at the direct information, what is relevant for the consolidation is this mainly. So if I read it, a board paper was submitted to seek the initial approval for a significant investment in the education sector. So they want to move to a new sector, education. At the moment, into telecommunication, need to move into education. Two investment opportunities were identified. And corporate finance team was asked with evaluating these options. Option 1 involves acquiring a well-established higher education establishment. Well-established higher education establishment that has been operating since 2019. Option 2 is to launch a new private campus to offer undergraduate and postgraduate degree program in the Republic of Maldives. Private campus for the undergraduate and the postgraduate degree program in a foreign country, Maldives. So these are the two options. Either to acquire a higher education establishment in Sri Lanka or else launch a private campus in Maldives. So these are two options. Then option 1 is given in detail. British College Colombo, BCC, is a tertiary education institution that provides world-class education in Sri Lanka at an affordable price for the students. So what is the company? BCC. So where the balance sheet or the stable financial position of BCC is also given in the pre-scene information. Currently, college offers both postgraduate and undergraduate programs in business administration and accounting and finance awarded by a leading top-ranked university in UK. The undergraduate program are conducted by Leeds Institute of Business Studies, a 100% owned subsidiary of BCC, right? So what happened? So there are two companies here. Leeds Institute of Business Studies is a 100% owned subsidiary of BCC. So you have BCC, the separate company which actually carries out postgraduate programs. On the other hand, undergraduate programs are carried out by another company called Leeds Institute of Business Studies, LIBS, which is actually a 100% owned subsidiary of BCC. So BCC holds 100% of share capital of LIBS. So two companies. This is of postgraduate BCC, this is of undergraduate studies. Now what is the probable unseen scenario by looking at the information? Because this is a radical change. Because now if you look at STL, that is into telecommunication. technology-driven, telecommunication-driven sectors. And they now need to diversify into totally a different business segment. But based on the information what is given in the pre-scene, okay, and not only that, you have been given the statement of financial position of BCC. So we have to definitely look at this as an option, which can be tested in the unseen. What could be the scenario is actually STL can acquire what? BCC. Once STL acquires BCC, it comes with a subsidiary. BCC has a 100% owned subsidiary. So it creates a situation of what? Complex group, vertical group. So if you look at, so this is the current structure. STL has two subsidiaries, two direct subsidiaries, PPL 90%, VTV 100%. Now, based on this particular para, option 1, let's assume STL acquires the entire share capital of BCC. Right? So, once STL acquires BCC, automatically the subsidiary that BCC has, LIBS, would also be part of the group. So now what will happen is, this is what I mentioned, this is a what? Vertical group. There's a subsidiary and there's a sub-subsidiary. So it's a complex group. So this is actually, I would say, one possible way of testing this particular consolidation question. So that means in summary, you need to have a knowledge about how to prepare the consolidation working for a complex group, especially for the sub-subsidy, how to calculate the goodwill, how to calculate the NCI, what are the changes. You need to be thorough with. Okay. I hope you are clear about that. Then, any questions in terms of the first matter, what I have mentioned? This is option now. This is actually scenario 1, which can be tested in the exam. Then, what else? Option 2, reading in detail, because there were 2 options suggested in terms of moving into the educational sector. The option 2 is involves international investment, because you are going to establish a new campus in Maldives, right, in a foreign country. Involves international investment. Proposal is to lease a suitable building in Male city. So the capital city of Maldives is Male, located in Republic of Maldives, and establish a fully fledged private campus in collaboration with a top rank university, which will serve as degree awarding body. Right. So you have to collaborate with a top rank UK university. That would be the degree awarding body. What you want is actually to have a campus in Male City, Maldives, located in Republic of Maldives. And if I go back, you have been given the details over here as well. Option 2 is to launch a new private campus to offer undergraduate and postgraduate degree program in Republic of Maldives. So you want to, what you want is actually to lease out a building, right? You would become the lessee and have this campus. Now, what it can be tested over here? A lot of people would say that, okay, it can be a foreign subsidiary consolidation. Because you are now, if you establish in Male, what is the currency in Male? Rupiah. So in Sri Lanka, rupees, Male rupiah. Now, you have different functional currency. So if it's a foreign subsidiary, you have to do the consolidation by taking that into account. So the way that you approach the question is different. The workings that you need to do. Because if it's a foreign subsidiary, you have to calculate the goodwill in foreign currency. Right? Then now, if it's a foreign subsidiary, if you go and acquire, what is mentioned in the pre-scene can be different when it comes to unseen. Now, according to the pre-scenes, it seems that you go there and establish a campus by your own. But in the unseen, examiner can say that, okay, here you found that there's a campus which is already established in Maldives where you want to acquire that. So then it's a foreign subsidiary. Okay, so you have to do the consolidation for the foreign subsidiary. So there are goodwill has to be calculated in foreign currency, then it has to be translated at closing rate each and every year. That would amount into exchange gains and the losses. In addition to that, subsidiary financial statements, assets, liabilities need to be converted into functional currency of the parent company at the end of each year. So P&L numbers has to be converted. We are going to use the average rate. So the approach of consolidating a foreign subsidiary is different. But by saying that, specifically by looking at the business context and the actual context in Maldives, Maldives is a very small country, right? If you look at Malé, you can walk through the island, entire Malé island within 45 minutes, right? Wherever you stay in Maldives, you can see the entire, sea in all corners, basically in 4 sides. Wherever you see, it's sea. A small country. So this is Malé is the capital city, capital island. There's a law in Maldives where foreigners can't own the businesses. So if you want to have a business in Maldives, there should be a local partner. Now, when you look at this context and apply this to the scenario, if examiner wants to follow the free scene, right, in the unseen, because there were times where there's no connection between the free scene and unseen. I believe that he will maintain the discipline and ensure that there's a connectivity between the free scene and unseen, as well as the business context in Maldives is you can't own a business by your own. Foreigner can't own. So which means definitely you need to have a local party. So what you can do, what you can have, there can be a situation where this is what is there in the pre-scene at the moment. SLT holds 90% of PPL and SLT holds 100% of VTV. What SLT can do is SLT can enter into a what? Joint venture with a Maldivian investor, where STL and this Maldivian investor has the what? Joint control over this joint venture. Right? So based on the information given, that is what is possible, I believe, in terms of the option 2. And also the business context, the law in Maldives. Now, if it is that, you should know about SLFRS 11 joint arrangements. So joint arrangement means where 2 or more parties have the joint control over. So what do you mean by the joint control? So the relevant activities are decided with the unanimous consent. Now, if there are 2 parties, both parties has to agree. SLT and this particular investor has to agree on the decisions about the relevant activities. Unanimous consent is required. So if this will only apply if the relevant activities require unanimous consent of those who collectively control the joint arrangement. So then we say that, okay, 2 parties are having the joint control. It's not the sole control, right? Neither of these 2 parties can alone control. They have to get together and control. And the other thing that you need to understand is in this particular standard SLFRS 11, under the joint arrangements, there are 2 types of joint arrangements. It can be a joint operation or a joint venture. So it is depending on the parties' rights and obligations of the arrangement. So basically, if it is a joint venture, what will happen is there's a separate entity established like this. Now, the example what I have given here is a joint venture. Why? There's a separate entity. Then once a separate entity is established, and if the percentages are 50-50, it's not necessarily to be 50-50, right? It can be 55-45. But if the decisions are made with unanimous consent, it's a joint venture. Now let's assume for simplicity it is 50-50. Now to say that the particular joint arrangement is a joint venture, there should be a separate entity, and the parties have rights over the net asset of this joint venture. Again, if I say that SLFRS 11 is about joint arrangement. In joint arrangement, what it says is parties needs the joint control over the unanimous, based on the unanimous consent. So the relevant activities are decided based on the unanimous consent. So the parties are having the joint control. So it's a joint arrangement. So the joint arrangements are 2 types, joint ventures and the joint operations. For you to say that it's a joint venture, there should be a separate entity established, as well as parties are having the rights over the net asset of this entity. Okay. The other type of joint arrangement is what? Joint operations. Joint operations means what? There's no separate entity. If there are two parties, parties are having the joint control over the individual assets and the liabilities. As there's no separate entity, there's nothing called net assets. But still, parties are having the joint control over the what? Assets and the liabilities. Then it's what? Joint operation. I have included that aspect as well. Two types of joint arrangements, joint operations, joint ventures. You can go through. But under the examination scenario, if this is going to be tested, I believe that it would be a what? Joint venture. Okay. So it's a joint venture between STL and Maldivian investor. So decisions or the relevant activities are decided based on the unanimous consent of STL and this particular investor. Then what we need to explain is how to do the accounting from the perspective of STL. So what do you say? If it is a joint venture, what is the applicable accounting standard for the accounting? LKS 28. LKS 28, what is the name of LKS 28? What is the name? Investment in associates and joint ventures. So if it is an associate, if it is a joint venture, similar accounting. What is the accounting? Equity accounting. So LKS 28 explains the accounting for the associates and the joint ventures. So that is what equity accounting. So I explained you what is a joint venture. So you have the joint control over the joint venture. Associate means what? That you already know. A particular investor has a significant influence over an investee, normally having 20% to 50%, right? Normally, you believe that investor has the significant influence over the associate. So if it is an associate or if it is a joint venture, in this case, what is possible is actually a joint venture. Your accounting is equity accounting. Equity accounting means a special kind of an accounting treatment. It's not consolidation. You don't do the line by line addition. So in balance sheet, what do you do in equity accounting? You have one line item under the non-current asset, cost plus share of post-acquisition net asset changes. Even in the P&L, one line item that shows share of profit after tax of the joint venture. Okay, so believe that you are aware about the equity accounting. So that is actually the second scenario which I can predict based on the information given in this pre-seed. Right. I hope you are clear about that. Okay. Right. That also a kind of a radical change, right? Why do I say so? Because company is in telecommunication, tech-driven, and you suddenly want to move into what? Education. Not only that, here you want to move into a different country, different product, different market. You are taking a risk, right? But we have to go ahead with what is given in the pre-seed. So based on that, we have discussed there's an option like this. Now these are the now before moving there, if this is tested, now if this scenario is tested, let's say you establish a joint venture in Maldives with another investor, there's another standard which is applicable, LKS 21, effects of foreign exchange rates. Now in that particular standard, one of the things that we decide is functional currency of the joint venture, right? When you now actually LKS 21 talks about three things. Number one, determination of functional currency and presentation currency. Then how to account for individual foreign currency transactions that we already discussed earlier. And third thing is how to consolidate, how to account for a foreign operation. This is actually, we have to decide how to account for this particular foreign operation. Now, before you decide the accounting, you need to identify what is the functional currency. Now, to decide the functional currency, a lot of guidances are given in LKS 21. What are the guidances? Because when you establish a foreign operation, in this case, a joint venture in Maldives, you have to decide whether the functional currency is the Maldivian currency. What is the Maldivian currency? Rupiah. Or else whether it is the currency of parent company, that is Sri Lankan rupees. You have to decide what is the functional currency of the joint venture. For that, lot of guidances are given in the standard. Now, out of these guidance, altogether actually there are 9 guidances for a foreign operation. Out of these 9 guidances, first 3 are the main criteria which is applicable for a foreign operation as well as a local operation. Now, if you look at these criteria, the first one says that what is the currency in which the sales prices are denominated, whether it is in Maldivian currency or whether it is in Sri Lankan currency, whether it is in rupiah or whether it is in rupees. Next one, currency in which competitive forces and the regulators determine the sales prices. Again, whether it is in rupiah or rupees. Then currency in which you incur your main cost of material cost, labor cost, right? Other direct cost, whether you incur material cost, labor cost in rupiah or rupees. You look at that and decide whether the functional currency is rupiah or rupees. Right? There are 3 main factors. Then there are 2 additional factors that you can look at. Currency in which your financing activities are generated. Let's say this joint venture wants to take a loan. What currency that you use to take this loan? Whether it is the Maldivian currency or whether it is Sri Lankan currency. Right? Then currency in which operating cash are retained. Once you generate profit, under which currency you retain them. Again, whether it is in rupiah or rupees. So you have to look at all these factors to decide the functional currency, whether it is Maldivian currency or Sri Lankan currency. And when you have mixed indicators, you have to use your judgment and decide which has a higher weightage. Okay, if most of the factors suggest that it is rupiah, Maldivian currency, functional currency would become rupiah. But I also want to highlight that when it comes to the determination of the functional currency, there are 4 factors which are directly or which are only relevant for the foreign operations. Now, in this particular matter, as it is a foreign operation, if you look at, now we are answering the question from the perspective of STL. From the perspective of STL, this is a foreign operation. Here, in determining the functional currency of a foreign operation. Foreign operation can be a foreign subsidiary, foreign associate, or a foreign joint venture. Number of additional factors. So these 4 additional factors are only relevant to the foreign operations. So what are these 4 factors? Need to have an understanding, because examiner can give you a scenario in the unseen about these factors, about these as well as these 4 additional factors, and examiner can ask you to determine the functional currency of that foreign operation. We have to be thorough with this criteria. Number 1, out of these 4 additional factors relevant to the foreign operation, degree of operational independence or the autonomy from the parent company. Okay, can that foreign operation make their own operational decisions, or else should it make the decisions based on the parent company? Right? Basically, whether you have the autonomy or not, whether the Maldivian operation has the autonomy or not. If they can make their own decisions, functional currency will be rupiah. But if they want to depend on STL is the party who made the decision of that foreign operation, then the functional currency would become what? Sri Lankan rupees. Okay. Then proportion of transactions with the parent. Let's say if you look at this Maldivian operation, very less transactions with the Sri Lankan company. Then what is the functional currency? Maldivian currency. But if you look at the total transaction, 90% of the transaction is with the Sri Lankan company and the foreign operation. Then functional currency would become what? Sri Lankan rupees. But if you look at this particular situation, if they want to have a campus, I don't think that there'll be transactions with SLT, right? So it would be less. So depending on that, functional currency would be what? Maldivian currency, rupiah. Then influence of cash flows on parents' cash flows and availability for the remittances. let's say this particular foreign operation, what they need to do is generate profit, generate cash, and remit that to the parent. Nothing else. At the end of each month, there's a remittance to the parent company. So which means what? Autonomy is not there. If autonomy is not there, functional currency would be the currency of the Sri Lankan company, rupees. But if the Maldivian company can retain their own cash and they can decide what to do with them, then there's autonomy, right? So then the functional currency would be Maldivian rupiah. Finally, what is the financial autonomy? Which means whether the foreign operation can pay their own debt without depending on the parent company. Again, it's autonomy. If financial autonomy is there, if the foreign operation can serve its own debt obligations, functional currency would be what? Maldivian currency rupiah. If foreign operation has to depend on SLT to pay their loan commitment or to meet their loan commitment, then the functional currency would be Sri Lankan rupees. So almost everything is with regard to the autonomy, right? If the autonomy is there, if the independence is there, then the functional currency is the Maldivian rupiah. But if the autonomy is not there, so the foreign operation has to depend on SLT, then the functional currency would be Sri Lankan rupees. That's how you determine. Okay, right. And I told you accounting treatment for the joint venture is not the consolidation, right? It is equity accounting. Associate and the joint venture, equity accounting. If it is a subsidiary, consolidation. Okay. Right. Okay. So that is actually the scenario. But as I said, as per the information given in this pre-scene, more likely to be, if it is a foreign operation, more likely to be a joint venture. Okay. Right. So then I already told you there are some hints where examiner has given in this pre-scene where he can test other types of consolidation other than these two direct scenarios, what is mentioned in the pre-scene. So look at this and think, what can be the scenario over here? Look at this para and see that whether you can guess what can happen here. What it says. In addition to its regular bank borrowings, STL has recently entered into an agreement with International Financial Corporation, IFC, and has access to a loan facility up to $100 million. Now you have a loan facility of 100 million from IFC. This funding will be used to expand and enhance broadband connectivity throughout the country. SLT has a funding facility of 100 million US dollars. This is to expand and enhance broadband connectivity throughout the country. Okay, let me ask this question. You want, now let's say, forget about the business. Think about you. You like to do what you know or what you don't know. Do you understand the question? You like to do what you know or what you don't know. What you know, right? So similarly, businesses, first option is not to do what you don't know. What you know and what you can do well. If you look at the two scenarios what we just discussed in the education sector, that's a totally new thing. Right? New product, they don't have any experience. But if you look at this particular scenario, STL can do something which they know. They can expand. It seems that actually in their business cycle, they have now reached to a, now if you look at Dialog, they have reached the maturity stage of their business. So very little room to grow. You have very high market share, but the growth potential is limited in that market. If you look at your matrix BCG, that is what? Star, right? So in that situation, you still would like to do and earn profit and cash from what you know. So now what you can do here is, and also your funding is available. Now IFC has funded 100 million USD. It is available. You can use it and don't need to worry about funding. And you need to just expand and enhance the broadband connectivity. That is an area which you know very well. It's mentioned earlier as well. Now this is an area where the technology is getting changed. So you need funding. Here the funding is available. So what can be done now? Now this is the pre-sale. STL has 90% over PPL and 100% over VTV. Now if you look at PPL, what is the business? So they are doing the broadbanding services, right? Already established business. So the broadbanding services are provided by PPL. What can happen easily? Now STL, earlier mentioned that STL, once they fund, now here STL has taken a loan from IFC, then STL can inject this money to PPL in way of equity capital or in way of debt capital. So either PPL will increase their share capital on the balance sheet, or else PPL would take a loan from STL. And what? Invest in a new company to expand the broadband service. Isn't it? Yeah, so you can acquire. It can be 100% or it can be 80%, whatever percentage. Acquire a broadband company. Not necessarily be 100%, can be 80%. Right? If there are companies to sell, they would acquire. So then yet again it creates a scenario of what? Complex group, vertical group, parent, subsidiary, sub-subsidiary. So because of that, we pay attention on complex group. It can be like this scenario one that I have explained. It can be like what? Scenario one, what I have explained. STL acquires BCC, which already has a subsidiary, LIBS. So then it's a what? Vertical group, complex group. So similarly here, this is the third scenario, what I'm explaining. Here also can have the situation of what? Vertical group, complex group, right? When it comes to complex groups, two scenarios, no? But it can be a vertical group or it can be a D-shaped group. D-shaped group is also called as a mixed group. Now this is a what? Vertical group. Under the complex group, vertical group. You should know that in a vertical group, how to calculate the goodwill, NCI, and all these workings. Okay, what's the difference? Right. So that is actually the third scenario. But that is indirect, right? Not direct as the first two. But if you look at the business context, if you think that, if you believe that you are in the board of directors, you represent the board of the STL, board would like to do what they know. But based on the pre-seen information, it's not direct. It is something which we need to understand by reading this. You have to connect the slots and say that, okay, this is what it can happen. Right, okay. Then next one, read this. Again, these are, not a direct scenario, not directly mentioned, but by reading it, we can guess what can happen. Read this part and see whether you can guess what's going to happen. It says, telecom companies deal with a massive amount of customer data. Companies gather information on how customers use their services, their interactions with the company, and details of their billing. However, in real challenge lies in shifting through this vast data ocean to extract valuable insights and make accurate predictions. So telecommunication companies are having actually vast amount of data about the customers. Their customer base is huge. If I'm not mistaken, here STL's customer base is about 15 million, right? So they collect vast amount of data. Now the challenge is to convert this data to information to make decisions, to convert that into insights to make decisions. Then with the aggressive digitalization of services in recent years, STL has accelerated its effort to embrace rapid advancements in wireless communication and new digital technologies such as 5G, edge computing, artificial intelligence, and application programming interfaces. So basically now what they want, now I told you STL, if you look at real life dialogue, is in the maturity state. And it's in the telecommunication, which means technology plays a key role. You have to go ahead with the technological changes. Now let's assume if the dialogue doesn't do the innovation, or if they don't change with the change in technology, they'll be soon outdated. New competitor can come and capture the market easily. So because of that, whatever the new development, what is mentioned over here, it's a must to embrace. Otherwise, you can't survive. So out of all these things, as well as here, you have a lot of data where you can't, you have the main challenge is to convert that into insight. Out of all these things, it seems that they want to move into AI. Definitely they must do it. It's not an option in the real business case. You have to go ahead with AI. Otherwise, you'll be outdated. With the ambitious goal of becoming Sri Lanka's premier AI-powered entity, so they have a goal. What is the goal? Becoming Sri Lanka's premier AI-powered entity. SLT is focused on catalyzing value creation through comprehensive data and AI initiatives. So they want to become a premier AI company. So what they can do? Either they have to develop this AI knowledge by their own, through their research teams and all. Or else, what is the fastest way? They can acquire an AI company, existing AI company. That will lead to a consolidation scenario. Right? So this is what is there in the pre-scene. STL has 90% over PPL and 100% over VTV. What can happen is STL can acquire, it can be 100% or it can be 80%, whatever the percentage, AI powered company. So then what? PO consolidation. Right? Or else sometimes this AI company is a, let's say, strong company, existing company. They might not want to give the control to SLT. At that situation, what SLT can do is SLT can enter into a joint venture with another AI company, right, to go into this area. So what can happen is, again, this is the pre-scene, 90% and 100%. Without STL to acquire a subsidiary, it can be a situation where STL and another investor who has this knowledge, AI knowledge, that particular investor is a AI expert, right? It can be a corporation or it can be an individual, right? So STL and this particular investor establish a what? Joint venture. So I explain about the joint venture, then decisions about the relevant activities are made with unanimous consent of STL and this particular investor. So that means STL and this investor has the joint control. Then you have to see that whether it's a joint venture or joint operation, right? So if it is a joint venture, separate entity established and parties are having the rights over the net assets. So normally in the examination scenario, if a joint arrangement is tested, it's a joint venture. So separate entity is there and two venturers are having the rights over the net assets. So yet again, you need to account from the perspective of STL, from the perspective of STL, accounting for a joint venture. What is the applicable standard? LKS 28, investment in associates and joint ventures. So this joint venture has to be equity account. Equity accounting means one line item in the statement of financial position, cost plus share of post-acquisition net asset changes of this joint venture. P&L also one line item, share of profit after tax of this joint venture. Your share of profit after tax. That means in this example, 50% of the profit after tax of the joint venture. Right? So again, as I said, this is not a direct scenario given, but based on the business context, that can happen. But I believe that if it is a AI company, most of the time it can be a subsidiary rather than a joint venture. But if it's a joint venture, also we know what to do now, right? Then all these scenarios what we discussed are acquisitions. And if you read pre-scene, it's more towards an acquisition, right? Generally, it has to be an acquisition. But I told you in certain examinations, examiner is making a U-turn, right? So he gives something else in the unseen. So if he wants suddenly, make a U-turn and test a disposal, what can be the scenario? Can you tell me what can be the scenario if it's a disposal? This is the para. This is the only para where he can, relate if it is a disposal. Read this. We read this para earlier as well when you were talking about the impairment. Information technology serves as the backbone of the modern telecommunications. PPL was acquired to invest significantly in technology to improve its customer service and upgrade broadband infrastructure to top-tier standards. However, securing a substantial amount of additional capital while maintaining optimal capital structure proved to be a challenging task for PPL. PPL was acquired. It was acquired in 2017 with the intention of what? Improving this broadband infrastructure. But the matter is, it's technology driven. You have to invest a lot of money in the technology advancements because otherwise you'll become outdated. So for that, now the structure, the method that this particular group follows is, now let's say if PPL wants additional funds to invest in new technology, STL has to find out. Then STL would either give this funding as equity capital or loan capital to PPL. Now, this would be a headache to STL because why? Every year you need to make significant investment. So by looking at that aspect, if STL decides to dispose PPL, it will be a what? Disposal scenario. Right? Then after the disposal, STL just have VTV. It can be an entire disposal or it can be a partial disposal. Now, if you look at disposals, I'll come there. Now, the scenario is if you look at PPL at the moment, STL has 90%. So what are the disposal scenarios? This entire 90% can be disposed. So then the 90% holding would become what? 0. So it was a subsidiary, now nothing, entire disposal. Or else you had 90%, you might dispose 60% and you retain what? 30%. So you bring another, or you transfer the control to someone else where you retain a significant influence. So then your subsidiary will become a what? Associate. Or else it can be a scenario where you had 90%, you dispose what? 80% and retain 10%. Then this subsidiary would become what? Normal investment. So if it's a normal investment, you need to apply what? SLFRS 9. It's a financial asset. 10% means it's a financial asset. 30% means associate. You need to apply LKS 28, investment in associates and joint ventures. Right? Equity accounting. Now, the common factor of the first three scenarios is, what is the common factor? In all these three scenarios, parent company, in our example STL, is losing the control. Control is lost. Okay, here entire disposal, here only an associate, here only a financial asset. So control is lost. So because of that, accounting treatment. So basically here, when you have a disposal where the control is lost, disposal where the control is lost, you need to calculate the disposal profit to be included in the consolidated statement of profit and loss. So how to calculate the disposal profit? There's a format. You have to take the sales proceed. Now, if I take this second scenario, you have to take the sales proceed of this 60%. Then you have to take the fair value of the retained interest. So what is the fair value of the 30%? Sales proceeds plus fair value of the retained interest. You add them together. From that, you deduct net asset value of this entity, PPL, at the disposal date. To that, you add if there's any goodwill at the disposal date. From that, you deduct non-controlling interest value at the date of disposal. Net asset at disposal plus goodwill at disposal minus non-controlling interest, because you just had only 90%. That means 10% is NCI minus non-controlling interest value at disposal. You take the net answer of that. That net answer you need to deduct from the total of sales proceed and the fair value of the retained interest. So you calculate the disposal profit. Look at how to calculate the disposal profit if the control is lost. So the approach that you follow is similar in terms of this calculation of disposal profit under the first three scenarios, because all these three scenarios you lost the control. And the disposal profit, as I mentioned, needs to be included in the consolidated statement of profit and loss. Right? Then the fourth scenario is you had 90% of PPL, you just disposed 30% and you retain how much? 60%. So here control is what? Retained. Control is not lost. Then the accounting would be different to the first three. Because here you are not going to calculate any disposal profit or loss. Because why? Control is retained. It's a transaction between the equity holders. Because earlier when you had 90%, what is the holding of NCI? 10%. Then when you dispose 30% and once your holding is 60%, what will happen to the holding of NCI? 40%. So your holding would be reduced, or the parent's holding would be reduced by 30%. On the other hand, NCI holding would increase by 30%. So it's a transaction between the equity holders. So you're not going to calculate any profit or loss here to be included in the consolidated statement of profit and loss. You just make an adjustment in the equity. Okay, how to do the adjustment? If you can't remember, you have to go and look at. Okay, no impact on goodwill, no profit or loss to be calculated in the consolidated P&L. It's a transaction between equity holders. So the impact has to be adjusted directly in equity. But I believe that if this is tested, if it's a disposal, definitely, most probably it can be an entire disposal where the control is lost. You might not retain anything, you dispose the entire thing. If examiner wants to test a disposal. So what I have explained is listed down over here. You can go through about the disposal scenario. I have explained everything. With this example, you can go through, right? Right. So that is what I explained. So you are disposing PPL, then you just have only VTV. It can be combination of the scenarios that I have explained. It can be accompanied with a disposal and an acquisition, right? One of the acquisition what I have explained with a disposal, that is possible. Right. Okay, by looking at the pre-scene, this is what I can predict in terms of the consolidation. We looked at number of scenarios. So in summary, the areas what is important is complex groups are important. Accounting for joint ventures are important. As well as if examiner wants to test a disposal, I believe that he would test acquisition and a disposal. In that case, how to account for disposal of a subsidiary is also important. Right? So these are the important aspects in terms of the consolidation. And I already explained you the functional currency, concept of functional currency is also important if it's a foreign operation. Right? Okay. Yeah. In addition to that, there's a para over here. This is actually basic consolidation concepts, STL accounts for business combinations using the acquisition method of accounting. Yes, obviously business combinations, you need to follow the what? Acquisition accounting, that is consolidation. Accordingly, the identifiable assets acquired and the liabilities assumed by the acquiree are recorded at their acquisition date fair value. When you acquire a subsidiary, what you do? You have to fair value all the identifiable assets and the liabilities of the acquired subsidiary. Group policy is to value the non-controlling interest at fair value at the rate of acquisition. You know, there are two methods of measuring the non-controlling interest at acquisition date. One is fair value method, other one is what? Proportionate net asset method. So out of these two, so here the group policy is to measure non-controlling interest at fair value. So that means within the goodwill, you have parent's goodwill as well as non-controlling interest goodwill. So you follow the full goodwill method. So in your exam question, sometimes examiner might not tell you what is the basis of measuring NCI, because why? It is already there in the pre-scene. Then don't confuse in the exam saying that, okay, examiner has given information, but he has not mentioned how to measure the NCI. Why he has not mentioned? He wants you to read the pre-scene. That's why he has given this 1 month ago. No? So here it's clearly mentioned that non-controlling interest is measured at the fair value at the rate of acquisition. Intercompany transactions and the balances and unrealized gains and the losses of the transactions between the group companies are eliminated. That is consolidation, right? If you have intercompany balances, intercompany transactions, unrealized gains and the losses are to be eliminated, because in consolidation you consider parent and all of its subsidiaries as a single economic unit. Goodwill that arise from the business combination, especially from these two acquisitions, what STL has done in the past, is not amortized by STL, but it is tested for the impairment annually. That is also correct, no? Goodwill won't be amortized. Goodwill is not going to be amortized. What you need to do is you have to test the goodwill for the impairment on annual basis. Whether indicators are available or not. Normally, you do the impairment testing only if the indicators are available. But there are three assets where, irrespective of the availability of the indicators, you must test for the impairment. What are these three assets? Number one is this, cash generating unit to which goodwill is allocated. Now, two subsidiaries that STL has acquired, if there's a goodwill figure, so that those two subsidiaries are cash generating units to which goodwill is allocated, you must test for the impairment. So the other two are, for your knowledge, intangible assets which are not yet available for use, and intangible asset which has indefinite useful life, right? So those three items, irrespective of the availability of the impairment indicators or not, you must test for the annual impairment. Actually, this para is the accounting standard, right? Only useful information here is this. NCI is measured at fair, because you have a choice, fair value method or the proportionate net asset basis. If I am the examiner, I won't tell the students in the exam paper the method of measuring the NCI, because I have already told this in the pre-scene. So that's why be careful on that. Right. So basically, these paras, what are the applicable standard? SLFRS 3 business combination and SLFRS 10 consolidated financial statements, that you know. Right, with that actually, areas relevant with the consolidation is also done. Now we deep dive about the standards as well as the consolidation, right? All possible scenarios have been looked at. Direct as well as indirect scenarios based on the pre-scene have been looked at. Then final area, what I wanted to touch is actually analysis and interpretation, because if you look at the recent past papers, always there was a question from this DuPont analysis, right? So return on equity, one of the key ratio that the investor is looking at. If you are an equity holder, you should know that what is the return on your investment. So then this return on equity is a combination of three key important ratios. One is net profit margin. This is what? Net profit margin. Right? Net profit divided by revenue. Then revenue divided by total asset. This is asset turnover. Asset turnover. into total assets divided by shareholders' equity. This is equity multiplier. Right, equity multiplier. This shows the profitability, net profit margin shows the profitability. Having a higher net profit margin is always better. This shows the efficiency of utilizing the asset. What does that mean? For 1 rupee investment in asset, how much of revenue it generates? Now, this telecommunication industry is highly asset driven. A lot of fixed assets are included. So here the ratio says, so 1 rupee investment in assets, how much of revenue that the company generates. This shows the gearing. So basically having a higher ratio means what? In your capital structure, you have less equity. If you have less equity, if the denominator is less, ratio is high. So having a higher ratio means less equity, more debt. So you can increase the return on equity by increasing the gearing. But you remember there's a risk, there's a financial risk. When you have more and more gearing, financial risk is high. What do you mean by financial risk? Now, in terms of equity funding, what we pay is dividends. We pay dividends only if we make money. Otherwise, we won't pay dividends. But when you have debt funding in your capital structure, in this group, debt ratio is about 71%. It's very high. Financial risk is high. What does that mean? Whether a company make profit or losses, you must pay interest. It's a commitment. It's a fixed commitment. So that's what we say, that when you have more debt capital, when your equity multiplier is high, your financial risk is high. But in terms of the return on equity, you can increase the return on equity by increasing this ratio. So the tendency in the past examination was, examiner is giving you the return on equity current year and the previous year, or else company's return on equity with a competitor, and wants to analyze what has happened to the return on equity, whether we are doing well or not. Right there, when you are commenting on the increase in or decrease of the return on equity, let's say the return on equity is decreased during the year. Comparing with the last year, return on equity has declined. Then you have to find out where the problem is. Whether the problem is in profitability, whether the problem is in efficiency. This is the efficiency of utilizing the assets. Or whether the problem is in gearing. Right? So when you look at the breakdown, easily you can comment about it. If you look at the recent past paper questions, you can easily cover this particular area. So be aware about that. Because if you just net off, now let's say revenue to revenue, net off. Then total assets to total assets, net off. Then what is remaining? Net profit divided by shareholders' equity. That is return on equity. Net profit divided by shareholders' equity. Then once in the past, so this net profit margin is further split, and the questions are tested out of that, further split into 3 main ratios. What are the 3 main ratios? Operating profit margin, how to calculate the operating profit margin? PBIT, profit before interest and tax, divided by revenue. Then interest burden. How to calculate the interest burden? Profit before tax divided by profit before interest and tax, and tax burden. How to calculate the tax burden? Profit after tax or net profit divided by profit before tax. So you further analyze, let's say net profit margin is declined. Is it because of the decline in the operating profit margin, or is it because of the interest burden, or is it because of the tax burden? Right, have a look on this particular analysis. In addition to that, because in this pre-scene, if you look at, a lot of ratios have been given, a lot of figures have been given. Be aware about the other ratios as well, like profitability ratios, like what you call return on equity. return on equity we already discussed. So other profitability ratios like return on capital employed, gross profit margin, right? Be aware about those. Then I don't think that liquidity would be tested because no information has been given about the working capital ratios or the current ratios or the quick ratio, but also the gearing. Gearing, you can calculate debt divided by equity or debt divided by debt plus equity. And interest cover, right? Interest cover, how to calculate the interest cover? Profit before interest and tax divided by interest expense. So be aware about these, basic ratios. If examiner tests something, those are easy marks. Don't miss those marks. Right. Then with regard to sustainable reporting, I believe that Indonesia has already discussed about it. Because of that, I'm going to cover it up. So the new standards LFRS S1 and S2 are critical, important. And also the integrated reporting, have a look, right? Because these are easy marks if these are tested. Because if sustainable reporting is tested, it would be a very easy question, right? It's a direct question, no complications, basics. Right. Yeah, with that note, actually, I have now covered, it was a long session. So I covered all the areas relevant with the financial reporting aspect of this paper, right? So focus on these areas. If you can't remember the theory aspect, just go and look at the theory quickly and revise your knowledge. So those are the things what you need to know in terms of the financial reporting. Anything that you need to check with me, or else can I make a conclusion for the session? Okay, there's a question whether there would be questions in terms of the IFRS 17, in terms of the insurance stand, not relevant to this particular pre-scene. It's a, examiner's liberty, as I mentioned. Right, so seems that there are no questions and we took a lot of time. So thanks for being there for a long time. The information or this particular presentation, I'll definitely share with CS Sri Lanka. So Sri Lanka will share the presentation with you all, right? So don't worry, I will share the presentation, right? So with that note, I wish you all the best for the examination. Complete your examination in this cycle. Don't procrastinate. And also, I would like to thank CS Sri Lanka for organizing this session and inviting me to conduct this session. Wish you all the best for the upcoming examination. Thank you.